All right, guys. All right, team. So today we got Jerome Powell speaking in front of Congress today. That's what this is. So today Jerome Powell is going to be speaking in front of Congress, or maybe it's in front of the Senate. Let me see. I said it yesterday. Let me make sure this is right. So today he is going to be speaking in front of the Senate, not the Congress. My bad. Not Congress, the Senate. All right, guys. So yeah, let me know what you guys think regarding today. Let me make sure the stream is monetized. There we go. And let me get the music up. But yeah, so Jerome Powell is supposed to speak at 10 o'clock today, at 10 o'clock. So we got some time. Market's still ripping out, man. Maybe I should have held some of my swing trades, to be honest. But again, I'm not bummed out that I took profit. I think it was, okay to lock in profit where I did, Is Congress not Senate? Okay, I got it wrong. So yeah, you're right. It is Congress today, House tomorrow. All right, so according to the Wall Street Journal, they say Jerome Powell is likely to caution on Capitol Hill that strong economic activity this year could lead to Fed raising interest rates more than it expected to fight high inflation. I think that's a reasonable, according to the Wall Street Journal. What's up, Leo Pawn? Hey, what's up, man? Yeah, so it's Eastern Standard Time. So we still got a while, to be honest. So we still have about 3.5 hours. But that's all right. SPY at 405s here, so SPY did bounce really nicely. Google ripped up big too. I should have stayed in some of them, but again, I'm nicely green on the year. I don't think I should be upset about, stuff like that. I don't think that matters too much. We're going to do our poll like we always do here, Bullish or bearish on today's Jerome Powell congressional speech. There, vote on those polls. Let us know what you guys think. How's crypto acting like right now? All right, guys. So yeah, Bitcoin down at 22.4s here, 22.4s. All right, team. What's up, Jimmy? Meta up pre, reportedly planning another layoff. Yeah, layoffs have been causing a lot of bull action. Yeah, it's at 10 a.m. Eastern. Again, looking at our poll number, about 45 votes. And remember, today Jerome Powell testifies, I believe, right? Yeah, so Jerome Powell testifies. All right, guys. So yeah. What is he going to say regarding inflation? I think a lot of people think he's going to say some bad things, you know? You know, I think a lot of people think he's going to say some bad things. We're asking make this poll for 4 hours or 5 hours. And then, yeah, we'll post it like this. Do me a favor, hit that subscribe button as well, team, if you haven't yet. We appreciate it. Doing our poll now, as we always do. We got our poll live here, guys. All right, guys. So yeah, SPY's pulling back a little bit. I might buy this dip some here. You can see the volume weighted average price at about 405s. Hey, what's up, Johnny, Hugh, Marcos? You might say good things today, bad things tomorrow. Yeah, every time it's bullish, I think you should buy 100 shares of TRKA for the channel squeeze. It would be a good swing for you to 100 plus. I mean, 100 shares though, man. Let me calculate this. I don't think, yeah, I think 100 shares would probably be fine. So right now it's at 9. It's at 70, or what is it at right now? 95 cents. So, you know, I understand I'm only going to be risking about $100, but you know, this thing could easily give back 50%. So I'm really risking at least, like, I would say at least I'm risking, if I take that trade with 100 shares of this, I'm at least risking, like, I would say like $70, because this thing could easily just dump back down. But I still think it's a justified risk, and I'll probably go ahead and do that. I'll have some fun. Hey, what's up, Maximus? Yeah, man, we start the stream early. I'm in Texas time right now. Hey, thank you, Robbie. I appreciate it, bro. Thank you, sir. But yeah, so if you guys don't see this here, or you might not be able to see it, but check me out, bro. I'll just stick this right here. Can y'all see this? Yeah, you can, right? Look at that play button right there. But yeah, I'll probably buy a little bit. I gotta wait like 30 minutes before I can, but 10 a.m. is when Powell speaks. Honestly, no offense to everybody here, but the time that he speaks is literally in the title of the live stream, as well as scrolling right underneath you. Look right here. It literally says it so many places. So, Beach, I heard you were on Benzinga yesterday, man. Check your show out, bro. Cool, man. That's cool. All right, guys. So, yeah, SPY pull it back to 405. Bull run right now, man. Honestly, big bull run here. So, good to see the market actually start to do some stuff, to be honest. Yeah, some people said that the power was out for a lot of people overseas, or not overseas. The power was out for some people in Eastern U.S. Hey, what's up, HJ? I think it'll run till Powell and then correct. Hey, nice, man. Nice, Beach. Congrats, man. That's cool. Meta planning 1,000 more layoffs. TRK going to create some bags. Probably an offering will be announced after it taps $1. Yeah, that's what I'm assuming as well. Like, again, like for whatever reason, it's hard to explain. Like sometimes penny stock traders, they make people who are critical of the penny stocks like enemies. and they shouldn't. They should understand, like, most people are going to be skeptical. But I think the reason a lot of people are skeptical of these penny stocks, and even, no offense, Martin, but like, how many penny stocks have you called out here are down like really big from where you called them out, brother? Nothing against you, man. You know, like, I know you kind of chase those, and it's all good, man. Like I said, we all have our niche. Maybe it's not as bad as I remember it to be, but you know, it's one of those things where it's certainly possible we could get an offering hit on us for TRKA. It depends on what the filings show, to be honest. But again, I haven't really been watching it, you know. Is it pumping because they withdrew the offering? Okay. Yeah, I mean, that's good news for sure. It just means they canceled dilution. Okay, well, yeah, that's good then. Yeah, like I said, I don't keep track of these. I might buy a little bit then, you know. All right, guys. So I might buy the dip again. We'll look at TRKA. I'll consider it. It is up big. Again, I'm not hating on penny stocks, man. Like, it is up big. Yeah, y'all vote on my YouTube poll or my Twitter poll here. Looking at our actual poll numbers now, again, about 57% are bearish out of about 125 votes or so. 43% are bullish. Hey, it's pumping because I bought at. Did you really buy that many? He's testifying in front of Congress. Crypto. So he's testifying. I see a beach. They withdrew the S1. Hey, that's good news, man, for sure. Yeah, I mean, if you bought 20,000 shares, I'm sure that probably did influence it pretty big. I don't know, man. Like, I have a large enough account where I could certainly buy, you know, more shares than that, to be honest. Like, I could buy 100,000 shares if I wanted to of TRKA. The problem is that, like, I've seen it happen so much that, like, I'm scared of doing that, you know. Like, the most I would ever buy of a penny stock is a couple hundred shares, just in case it goes up, you know. Yeah, I don't necessarily disagree with that, Mark, you know. Like, I don't want to get too political because, to be honest, people just get so emotional about politics. And, like, I'm really not a super political person. Like, I usually go by policies, but I'm okay with taxing the rich. Like, I don't think we should infinitely tax them. And I think there's a balance between taxing them and discouraging innovation, because I think the more you tax, the harder it's going to be to innovate up, you know, at the top. But once somebody has 10 or 15 billion dollars, you know what I mean? It's just kind of they're not. I think we should tax them, a lot, because at a certain point, it's not improving their quality of life, and it's just kind of, and I understand they start businesses, and then those businesses end up hiring people and all that stuff, but yeah. Yeah, so today will be really fun, man. Again, we'll see what happens. I always love Jerome Powell interview days because we know we're gonna get a ton of people here, and you're gonna get some volatility in the market. And that's the question: is do we close green today? We did a poll number here. I would appreciate it. Oh, sorry guys, I bumped my mic. My apologies. I'd appreciate it if you guys vote on this poll. The poll's right here. Go ahead and give it a vote if you haven't already. Vote on this poll right there. There's the poll right there. Go ahead and give it a vote. Yeah, I mean, I think people are misunderstanding what I'm saying. I think, and to be honest, to a certain extent, what I'm saying is already true, which is that like once you have like 10 billion or more, they're already getting taxed incredibly high rates, and so it doesn't matter too much what I'm saying. Listen, trust me, I dislike taxes more than I pay tens of thousands of dollars usually in taxes every year. Like, I do not like paying taxes, of course. It's not a very fun thing to give the government, 20K. You know what I mean? And so I trust me, I don't like taxes either. But I understand they're necessary in some ways. Property tax is what gets me, more than anything else. Property tax is what I disagree with probably the most. Yeah, I mean, like I said, I'm not going to be too specific or too divisive over these comments. I'd rather just not talk about it too much. It's probably going to go again. It's too divisive of comments here, to be honest. It's just not something that I think is going to be necessarily good for us. Yeah, we're going to be live until he speaks. Yeah, and regardless of what you believe in that regard, it's all good. We're gonna move on to another topic, though. All right, guys. Got about 200 people here. Yeah, so Powell speaks today in front of Congress. It's a congressional testimony today, and then tomorrow in front of the House. House testimony tomorrow is kind of what's going down. So again, today is going to be a congressional testimony, and then tomorrow he's going to be speaking in front of the House, is what it is. All right, guys. So yeah, we are waiting to trade here. TRKA up to 94 cents, 94 cents a share, which is kind of crazy. I'm seeing this Benzinga post. Did y'all know that Warren Buffett lives in a home built in 1920? So Warren Buffett lives in a home built in 1920. I can respect that. At a certain point, you don't need more home, especially if you don't have kids. Like at a certain point, you don't need another, like a larger home. At a certain point, a larger home comes with more stress, is what it really is. Living with it means what do y'all think with this AI tech? I think AI is going to be the future, man. And again, I've said this many times before. I think the future of AI looks something like, I think what they're going to do is I think they are going to, I think eventually you're going to see something along the lines of dedicated programming languages, dedicated programming language-based AI systems. And they already have this to a certain extent, just to put it into perspective. Like they already have something like this, but in the future, you're going to see it refined in a much more efficient and better and more profound way. And it's going to make it so that you can say, hey, JavaScript AI, write me a function that adds two letters together, two numbers together, and then divides the sum of those numbers by 2, just as an example. And that AI system will spit out the JavaScript code. And number one, ChatGPT can already do this, okay? But this is just an example. So think of that in a much more complex code. Say, hey, JavaScript front end, AI system, build me a landing page that has 4 paragraphs about, dog training and then, make the font of the headline of each one bold, 12 size font of this, or so forth and so on. And it'll spit out that code very quickly. I think that's the future of it. And again, I think you're going to have like programming overseers who, you're still going to need programmers, but not in the same way that we need them now. Instead of having programmers that do kind of the grunt work, so to speak, I think we're going to have AI that does the grunt work. And I think, we're going to have overseer programmers that basically just kind of watch it and make sure it's doing it right. And they learn how to input that data into it. That's what the future of AI is going to be. That's why AI is going to change the world. People don't understand that. People don't understand why AI is significant. Is because, again, a lot of them probably have never programmed, and so they don't understand why this type of technology is interesting. But, a lot of them are like, oh, it's a gimmick. I don't believe it's a gimmick at all. I think it's incredibly useful, and I think it can be powerful. And again, really, when it boils down to it, take a lot of the grunt work away from building software. Is what it is. So it takes a lot of that grunt work out of building software, and that's very useful. Obviously, that's very useful, very significant. And will just save work, save time. It's one of the reasons Microsoft paid $10 billion for ChatGPT, because ChatGPT will only get better and better and better. And to put it into perspective, guys, like if you want to see what ChatGPT does, I can already do this. Like, watch, I'll show you. I have a ChatGPT account, and I'll show you what I mean by this, right? So I can already say, and I also have a Bing one. The Bing one's actually pretty cool. Like, watch. So I'm a React programmer, right? So I'm a React Native programmer. So, right. So I'm a React Native programmer. So I can literally go to ChatGPT and say, write me a React Native code that adds two numbers together and divides the sum of those numbers by 2. All right, so let's see if it spits this out. All right, so we asked it to do it, and it's taken a little bit of time, but it's still like it'll still do it for me. This is a relatively simple code. It should be. I don't know if it's going to put the import React DOM, function, whatever it is. Let's see if it spits it out. Maybe I should have done like a more base. React Native is more so JavaScript is where my mistake is here, I think. So let me open up a new chat, and I'll say, write me a JavaScript code that adds two numbers together and then divides the sum of those numbers by 2. This will probably be much faster. React Native is more of a library or database, more so than it is a programming language. It's built on JavaScript, so I'm just going to ask it because this should basically be something like function add to A, B, or something like that, and then it'll be like A plus B, or some code like this is what this code should look like. It'll look something like that, but we'll see if it does it. Do you think AI will replace teachers in the future? No, I think it's going to take a human touch to teach people things. Still, I still think it's going to take a human touch to teach people things. I might upgrade to Plus for ChatGPT. It's $20 a month. Priority access to new features. Hey, thank you, Darlock. I appreciate you, brother. Thank you so much, man. Right, here's the final code. So like, look, here's it spitting out the JavaScript code. It defined two variables. Sum is equal to number 1 plus number 2. Average is equal to sum divided by 2. And then it just logs in the console the average, which is sum here divided by 2, you know. Yeah, Steve, and it's bad. Just get along, team. No reason to argue about stuff like that. You know what I mean? Like, it's all good here, guys. Like I said, it's all love here. Just no reason to argue. If y'all disagree on that in that regard, you know, just, you know, kind of ignore each other, you know. Yeah, I have Bing AI right now. So yeah, I have Bing AI right now. Yeah, I've got Bing AI right now. And Bing AI is pretty cool. Like, look, I can chat right now with Bing AI. And I can do the same thing here. Like, I can do the same thing with Bing AI right here, too. So I can literally just say, write me a JavaScript code that adds two numbers together and then multiplies those numbers by 1,000, you know. yeah, so again, you see how fast it did this, much faster than the regular one. So it's interesting, man. It's interesting. We'll see where it goes. Speech is at 10 a.m. Yeah. All right, guys. TRKA pulling back here. We still got 10 minutes before I could actually trade on TOS, so we're just going to wait. Yeah, I mean, really, we called this drop on the SPY. Like, again, we've played this video a few different times. But we told people exactly what was going to happen. Like, watch it. And again, I'll show you guys us doing this. So, like, I'm actually really proud of this. I'm going to make a short about this pretty soon so people can see what, you know, me calling it, basically. He said a few different things. Yeah, let me find it. We got it. Hold on. Yeah, here it is, right here. And again, we're gonna make a short about this. But like, look, so we literally called this exact move that we're in right now on the SPY. So I'm gonna zoom in right now so you can see it. But like, I'll just zoom in. Like, look, so this is me. Oh wait, sorry guys, I messed it up. Hold on, my bad. Here, hold on 1 second. Sorry, I gotta. So yeah, this is me calling it. Again, I'm gonna. There we go. All right, so. And again, so this was when the SPY was at 410 not too long ago. Yeah, let me mute the music real quick. So I'm going to end up making a short about this. SPY. Somebody asked me, somebody asked me, should I buy the SPY? And it was when the SPY was at 410s, right? The SPY was at 410s. So on the SPY, I'm not going to, like I said, I told people this is what I would expect to happen if we're going to continue on this trend. Now, listen to what I said. What I would expect to happen is a dip down to 400. I think, again, if you look at the market, guys, over the last 4 months, if we really look at the market, I would expect something like this to happen, right? So far we have pumped up for a while now. You know, we pumped up big for a while now. Consolidating into this here, we're about right here now. I guess what I would expect is a pullback to 400 right here. And then maybe we get a bounce at 400. We could also break down a little bit, but I think this is where we'll start to kind of go like this. We did exactly this. So if you look at the trend here, so this is literally exactly what we did. This is exactly what we did. So, you know, you might say, oh, well, John, the market dipped under 400. It did. It did exactly this right here. So it literally pulled down a little bit, broke back above it, pulled back to 400 again, and bounced. And like, that's where we are now. And so it literally did exactly that. Like exactly what we drew here. And it kind of bases it off of extension. Like, you got to understand we'll make another leg up and continue like that. So yeah, that's exactly what we did. We pulled back to 400, consolidated, dipped down to like 390s, bounced back over 400, and then tried to make another leg up. And that's kind of where we are now. If you look at the SPY here, that's exactly what we got. I said that when the SPY was right here. You know, so the SPY was right there. So far since then, we have pulled back under 400, broken back above it, and started to go like that. So, again, TRKA, we did another one with TRKA. Yeah, it's something to understand, man. Like, I'm not permanently bullish. Like, again, people, like, sometimes I think people misinterpret me because what I always try to tell people is that I really have no idea. You guys know me. Like, I really don't know what's going to happen in the market, but like, extension is important to understand. You know, like, whenever everybody's telling you buy, you know, it's usually not the right time to. It's one of the reasons I haven't bought up in the last few days. You know, but again, we said this up here, and the reason we said it was simple. Is like, if you look at the actual trend here. So if you look at the actual trend here, This is the broader trend right now. We have confirmed this trend. Honestly, I like the trend even more now. Like, look at this trend right here. This is the really interesting trend in my opinion right now in the market. That is a really interesting trend. Now, that's an ugly way to put it. Like, so we'll fix this a little bit. But this is the more interesting long-term trend in my opinion right now. Like, look, so we'll put that up. We'll get rid of this. We'll get rid of this, and we'll zoom out a little bit. But this is the most interesting trend in the market right now, in my opinion, right here. Let's fix this a little bit. That trend right there. I think that's a really interesting trend where if we do it like that, it makes even more sense. That's the best trend to follow in the market, in my opinion, right now. I think it's just obvious. Now, again, I don't know if it's going to continue in that way. I don't know if it's going to hold that trend, but that's what we're in so far. And this is really the reason we didn't this is really the reason we made it all like we did there, is because it was due for a pullback. We were at the top of the trend range, so in my opinion, it was kind of due for a dip. Who? Yeah, who is that? I don't know who that is. Oh, you're talking about Murph. She hung out here. You're talking about Murph, who hung out here. Yeah, Sean says, John, don't you agree we were coming down to test the W pattern at 4 even now and possibly down to 39 even by the 14th? Maybe, but I think right now, like I said, if we put up a longer term trend, I think we're in the middle of the trend range, right? So what we do now is less obvious, I think, right? I think if we were at the top of the trend, it's more likely that we're going to pull back. If we were at the bottom of the trend, like we were at 390s, it's more likely that we're going to bounce. But at this point in time, we're right in the middle of that trend line. So we're right here now. And I think this is kind of, we don't know what we're going to get there. We're right in the middle of the trend. So we could reject. It could be something like this, and then we go like that. It could be something where we go to the top of the range and go like this, and then, continue on the way up. We don't really know. So it's something where I don't know what we're going to get now. We're right in the middle of the trend range. Powell is probably bearish. I really don't know. We don't know what he's going to say. A lot of people are speculating that he's going to be bearish. But check the 4-hour candles. A lot of people are speculating that he's going to be bearish, but again, I really don't know. Yeah, I mean, I'll tell you this, Sean. I think we're a little extended on the upside over the last couple of days. I think we're a little bit extended on the upside over the last few days. But all right, guys. So we'll see if the market bounces. Again, I do think we're a little bit too high up here for me personally, for me to want to buy stuff. We're at 405s. Like we've rebounded pretty big, basically down from 392s, 391s, all the way back up to over 400, and we're at 405. I think that's a little bit too extended on the upside for me personally. So. All right, guys. So it is now 6 o'clock. We might buy a little bit of TRKA. Hey, look at the drops that are showing up as this happens here. I'll have some fun and buy 75 shares. I'm not going to do a full 100. All right, we're in 75 shares right there. We're not going to do a full 100. But if we do squeeze up, great. We'll make money with it. If not, it's not the end of the world. I think that's the only way to look at it. Maybe we bounce here, but yeah, TRKA dipped. Looking at our Twitter polls here. We did do a Twitter poll. We also have this poll going on. We got about 309 votes so far. 45% are bullish, 55% are bearish. And I think most people are going to be bearish on this report, on the Jerome Powell report. I think most people are bearish here. You know what? We'll go ahead and add another 25. We'll make it 100, I guess. It's such a small trade, it doesn't matter too much. But we bought 100 shares. And I'm not recommending anybody buy it. I have no idea what's going to happen here. No idea. You could add a little bit more to it if it pulls back some. I kind of want to buy the SPY dip right now and then look for a short-term bounce. I might. Small trade. We'll take 50 shares here. But yeah, SPY is right there. Tesla up to 194s again. Kind of dipping down some, though. Tesla had a rough day yesterday. It dropped from basically 200s all the way down to 194s. So we got 100 shares at 89 cents. Kramer crypto? No, I didn't hear about that. Yeah, I don't think none of these candles mean too much, to be completely honest here. These are like 100 shares is so small in terms of like overall size here that it doesn't mean much. Yeah, for a small trade, I mean, I know I'm using a lot of equity. 405 times 50. So yeah, I mean, a $20,000 position in the SPY, but it's a day trade. So it's like, the reason I say it's small is because like our profit target is small. So I mean, it's we're using roughly 20,000 in equity in this trade, but like I'm not going to lose much. If I do lose, I guess is the point. Well, yeah, isn't CPI, Sean? CPI is on the 14th. I believe it's the 14th. It might be the 15th for the CPI. So yeah, CPI March 14th, 8:30. And again, as we always do, we'll stream that live. So we were dipping down a little bit. We could add up to 100 shares here on the SPY too. SE, C Limited. Yeah, C Limited is ripping up big here. Look at C. Up to 72s here. I don't know much about this stock. I'm assuming this is CDO, right? Assuming this is CDO stock, right? No. Company operates 3 businesses: digital entertainment, e-commerce, as well as digital payments. It's a business. C Money, Garena, and Shopee. for SE. Yeah, I don't know about any of those companies, and so I'm going to be hesitant to invest in this. I just don't know it well enough. I don't know it. I don't know, Happy. It's 10 a.m. Eastern Standard Time, so you're going to have to look up what that means with Pacific time. All right, but C just broke highs here, so maybe I'm wrong here. There's Tesla. Tesla bouncing up a little bit. We'll see if it pops back up. Again, we're in 50 shares of the SPY here. See if we get a little bounce roll through. All right, guys. So again, SPY is probably pretty close to break even now. Oh, we're slightly green in the SPY, but yeah, we're basically flat here. Yo, bro, do you use patterns? Kind of. I'm most of the time swing trading. In my day trading, I certainly do. But in my swing trading, it's mostly a mix of like extension, objective, like value interpretation, extension, PE ratio, and sentiment. All right, guys. So yeah, TRK bouncing back up. We're pretty flat. Tesla almost up to the volume weighted average price. SPY at 405s here. So SPY right at 405 level. C is ripping up. So SE is making moves up. Well, I mean, Derek, it's the way I swing traded is probably what a lot of people wouldn't consider swing trading, right? It depends on what you consider swing trading, I guess. The way I trade is I look for healthy blue chips. I only do it to blue chips. I think mid caps are just risky. I think most mid caps, or not most of them, I would say, but I think a decent percentage of mid caps are going to basically deflate from hype being over, right? I think a lot of mid caps are really hyped up and they start to go up, and then when people realize they're not really what everybody's claiming them to be, like they're not as successful as they seemed in the beginning, then they kind of just deflate back down, right? You could look at like Peloton, you could look at BYD. There's just a lot of these stocks that do this exact same thing, that I'm just skeptical to invest money in. So I don't do it with mid caps. I definitely don't do it with penny stocks because most penny stocks are going to have long-term downtrends. But what I do it with blue chip healthy companies that I know, right? Like Disney, Apple, Google, Amazon, like whatever it is. And what I try to do is I try to wait for a profound pullback to happen, like a big emotional pullback. Like I need a large pullback. Sometimes it's from earnings. A lot of the time it's actually from earnings. And again, we've done this every earnings season pretty consistently. Most of the times it's from earnings. And so again, what we do is we wait for big emotional dips. Sometimes they're from earnings. Sometimes they're from Jerome Powell, comments for whatever there are. If we get big dips today, we'll consider buying it. But for whatever reason, we look for big pullbacks in healthy, low PE blue chip companies, right? And then we basically buy that dip and we look to rebound. And if we rebound in a couple weeks, great, we'll take profit and we'll treat it as a swing trade. If it takes a little bit longer, because they're blue chip healthy companies, I'll hold those things for years if I really need to. Most of those are eventually going to come back, and I have the buying power to be able to buy it and sit on it if I really need to. But again, most of the time I don't need to do that. Like the last couple trades we did this on, we bought Google just now, a week or two ago. When I don't remember when it was. It was sometime within the last month. We bought Google at the low 90s. It's at 96 basically right now. We bought what was the other one? We bought Ford at 1220s. Ford, it was at 13s yesterday. We ended up cutting it over the last few days. We did this with a number of different stocks, right? We did it with Ford. We did it with Google. What else did we do it on? We did it with Microsoft multiple times with Microsoft on the pullbacks, and then we took profit on the bounce, and then we added it back on the pullbacks, and then we took profit into the bounce. And so again, the only one we really lost on was Lyft. We bought Lyft. And it was a small trade, so we didn't really lose too much. I think we lost like $30 from that trade. But because of that, we buy the big emotional pullback, and we take profit into the bounce. Again, it works really well for me. A lot of times people will try to discourage you from buying stuff, right? Like fearful when others are greedy when others are fearful mindset really is like important to have, because again, every single time I buy these stocks, we did it with Snapchat dipped down to what, like 7s and 8s last year. We bought that up and just sat on it, wrote it back up to 10 plus. And every time I do this, somebody's like, oh, nah, bro, what are you thinking? Why are you buying that stock up, bro? The market's going to crash, bro. You didn't know? And then it never does. It never crashes, right? They always are just kind of, again, I'll put it this way. We've had a lot of bears in this chat over the last 2 months. We've had a lot of bears in this chat, right? That have been telling me, don't buy, the market's going to crash. Don't buy Google, the market's going to crash. Don't buy Ford, the market's going to crash. Don't buy Microsoft, the market's going to crash, right? Those people are mostly gone. They're not here. It's crickets now. Why do you think that is? It's because they were wrong. They know they were wrong about it. And so in the end, you got to take your own trades how you want to trade. You got to take the trades that you want. You have your own best interest. And most of the time people are biased. Like if you're holding, huge sizing and put options, it's confirmation bias. You overestimate the likelihood of a crash happening, and crashes are very difficult to predict. They're incredibly difficult. You got some people saying, oh, well, when we have to hit a recession, whenever the rate hikes are at the way, we have to hit a recession. To be honest, to a certain extent, we might already be in that. We've already had that. We've already had 2 consecutive quarter negative GDP growth. And so that might have already been there, and when they look back at this point in time, they might say we already had that and we rebounded back from it. Again, I don't know. Again, we'll see if I'm not buying it up right now because I think we're too extended on the upside, but I will say that crashes are very difficult to predict, and you can jump on the crash bandwagon, that's fine, but I don't buy it necessarily. Maybe if we do crash, I'm not going to be mad either. I'll just buy stuff up. Yeah, right. Exactly. Snow, you see that, man. He said your accuracy has been on point. Those same people that called you out are gone. They're right, 100%. Right. Because, again, if I'm like, hey, I'm buying Google, and I get in at 91, and Google's ripping up 96, 95 every day, that's hard to watch. Again, confirmation bias is strong. I'm not saying we're not going to crash, guys. Let me put this into perspective. I'm not saying we're not going to crash, right? But I think people telling me not to swing trade based off of a potential of a crash happening sometime over the next couple of years. Listen, if we do crash, I'm just going to buy up stuff. Honestly, I wouldn't mind a crash, because a crash would mean, and again, this is somebody I'm green on the year doing what I'm doing. I'm flat on most of my swing trades. I cut all of them. I'm out in profit in all of them already, or most of them at least. And so I'm not going to stop swing trading just because a crash could happen. And again, maybe it does. I'm not saying it doesn't. I'm not going to stop trading based off of a potential crash happening right now. Again, and y'all can do whatever y'all want. It's all love here. Like I said, everybody trades differently. We all see different things, and that's okay. I'm not saying the bears are still here. I'm not buying up anything now. I'm not buying up anything right now. I think we're too extended on the upside. And so I'm kind of bearish right now. I think we might pull back a little bit, especially with the Jerome Powell conference happening. But there's a difference between pulling back and market crash. That's the difference. Most of the time when I'm buying stuff up, it's after big, profound pullbacks in the market. And so I don't mind a pullback. I really don't. People act like I'm a perma bear or a perma bull. I'm really not. Like, I don't want to buy anything right now. I think we've moved up too much, and I think we could pull back some. But maybe I'm wrong. I don't know. What would you do if we crash 70%? 70% is very, very large relative to other crashes. Anonymous. Like 70% is big, bro. Like that's a big crash. Like most crashes are what? Like 20%, 25%. If we crashed, I would just buy stuff, man. I would buy blue chips, man. I'd buy Amazon and Disney and Google and Apple and Walmart, and stuff like that. Like that's what I would buy. And I would just sit as long as I needed to. Most of the big money is made during pullbacks like that. My guy over here, Tazzy, is just mad about it. Hey, GG to you, sir. Number one, I'm just going to correct something. He said, imagine trading on 1 minute time frame, acting like you know things. Bro, to act like I'm analyzing charts on a 1 minute time frame. My guy, like I said, man, your emotions are talking over there, Tazzy. It sounds like you were just wrong and like you're upset about it. So GG to you, sir. Have a good day. But no, obviously I drew this trend earlier. And again, I think this is the trend that we've been in, right? I think this is the trend we've been in. And I called this weeks ago. Again, don't make me play my short again because I will. Again, we called this weeks ago exactly what was going to happen. When the SPY was at 410s, people were asking me, hey, should we buy it? Should I buy? And I told them, look, I don't know what's going to happen, but I'm not buying right now. And I drew this trend right here. Like I drew this thing. Again, weeks and weeks ago before this, I drew this exact thing. It looked like that is what I drew. And that's basically what's happened so far. But yeah, like I said, like in the end, people get weird because they put out projections and their projections are wrong. And so then they get mad at the people who were actually right about it. And that's like I said, it takes a really mature person to be introspective and be like, hey, I was wrong here. I'm certainly wrong. I was wrong about Tesla. When Tesla was at 100, I didn't like Tesla at all at 100. I was wildly wrong about it. And so we always have to admit we're wrong sometimes, but you can't get mad at the people who are right. That just shows emotion. Yeah, I do that all the time, Chris. Yeah, definitely top 3 trend drawers in the world right now, for sure. Top 3. But no, yeah, I do that all the time, Chris. Again, it's all relative to time frame. Again, he's acted like I only look at stuff on a 1 minute time frame. I'm looking at a 1 minute time frame right now because that is what shows the most price action. Like if we're analyzing short-term price action in pre-market, I'm going to look at a 1 minute chart. If I'm looking back for swing trade potential, obviously I'm not looking at a 1 minute chart. I'm looking at a 20-day chart. I'm looking at a 6-month chart here, 180-day chart. And again, the trend still stays the same pretty much. But yeah, when we day trade, we're obviously day trading off the 1 minute chart. And again, like I said, people can say whatever they want. We're green on the year, which is better than I would say a large majority of other traders out here. Like we're actually green on the year. We paid capital gains taxes last year as well. That's all I'll say. And so people can say whatever they want, but y'all know, if you watch the stream long enough, anyways, we did buy a little trade on the SPY here, and we're sitting on it basically break even right now, and we will cut it if it breaks underneath it. But yeah, when we're taking a short-term day trade, obviously we're going to look at a 1 minute chart. Hey, what's up, Chris? Good morning, man. We are getting a mild pullback, maybe. Maybe we do. Right, 100%. That's what you got to do. Take profit when you can. Don't get too greedy. That's what we try to do, Yeah, I think you can use whatever time frame you want. I think the reality of what this is, to be honest, I think you got a bunch of people who are down on the year, who are actually losing money on the year, who get emotional. It's just emotions, man. It's really what it is. Like, it's just people. Most of the time, the people that get weird with me are people who are just losing money. Maybe they held a bunch of put options on this latest rip, and then, that hurts. And so kind of misery loves company type of thing. So they're like, oh, man. But in the end, like I said, you got to just go your own direction. Cash is the greatest position. I disagree. I don't think cash is the best one. I think sitting on cash is a bad move right now. Now, if you don't believe in the market, you could buy gold or something like that. But I don't think sitting on cash is. I think very rarely is sitting on cash a good move. I'll put it that way. I think there's obviously, if you think the market's going to crash, buy gold. If you don't think the market's going to crash, put it in an index fund or something. Cash is very rarely the right move, especially with inflation being as bad as it is right now. But again, maybe I'm wrong. Again, yeah, for sure. No, I just buy or sell stocks, Barry. So Barry says, when you day trade, do you buy call or put options? I most of the time day trade futures, but I also day trade stocks. Like I said, I'm in the SPY right now with 50 shares, and so we got about this is about 20,000 in buying power on the trade, and so we buy shares, but we also buy futures. I very rarely buy actual options, just because I have the buying power to where I don't necessarily need to do that. Tesla just dumped under the 200 EMA. Again, we'll see if it holds. Yeah, 100%. Rob says, I feel like people who are always talking about market crashes actually want the market to crash. I mean, here's the thing. Like again, bears get weird with me because most of the time they've been wrong, right? And so again, if you tell somebody the market's going to crash and then another person buys stuff up and then the person that buys stuff up was correct and the market doesn't crash, like I said, a lot of people are just emotional about it. But with that said, I think there is a chance that the market pulls back, right? Like, I'm flat on my swing trades because, again, I think the market is a little bit too extended on the upside right now. And I think that if Jerome Powell says some negative things, we could pull back. Again, we could pull back. I think we could pull back reasonably down to like 370s, 380s, 370s. I think that's a reasonable thing to consider. Not necessarily saying it's gonna happen, but I think that we could always look at both sides. I think we could hold and we could do well, but I think with the inflationary data that we've had over the last month, it wasn't necessarily good. Is the easiest way to put it. It wasn't necessarily good. And so one of the things that I'm sitting here waiting for is the Jerome Powell congressional testimony today, and then we've got the House testimony tomorrow. So again, I'm not saying the market's going to go up. I really don't know. And again, I'm flat on my swing trades right now. No, everything's too extended for me. Go Follow says any ideas for swing trades today? I don't know. again, market's still a little bit too extended on the upside for me to really want to buy up anything for swings right now. And as well as the Jerome Powell testimony, I'm not against bears, man. Again, most of the time, for whatever reason, like I've run this live stream for years and years, bears are more emotional. They get mad when they're wrong. They're more emotional about it. I think sometimes bears are a little bit more gambling in nature. Like they like gambling on things a little bit more. Again, not always, and everybody's a little bit different, but I think that causes some toxicity to come out with them sometimes, where it's like if I'm telling, I could be wildly right, green on the year, obviously I caught out a lot of these moves that did happen. Like there's no question whether I was right about the last couple months of trading, because again, we showed you guys, we made the predictions ahead of time, and then we were right about those predictions. And again, we have the video clips to prove it. But even with that, people will get mad and people will act like I just have no idea what I'm talking about because I don't agree with them. And again, I think that's just emotion coming out. I think, like I said, I think if you're extended on the short side and you're down big, it might be hard to hear somebody like me be like, hey, the market's not necessarily going to crash. The market doesn't necessarily have to crash. But like I said, bears, I'm not against you. At home, I'm not against you. I think we could pull back some for sure. I don't know if we're going to crash. It crashes like 20%. In order to justifiably crash, we'd have to dip like this. We'd have to go like this. And that's a big, that's big, right? And it could happen. I'm not saying it's not going to happen. What I'm saying is that it's definitely not happening yet. And so far, we're still in this upward trend. Now, again, things that could influence this to happen are for, again, we have CPI coming out on the 14th. In exactly a week from now, we have the biggest inflationary metric that the market specifically looks at, which is called CPI. It's the Consumer Price Index. That drops on the 14th. If that comes in hot, like high, higher's worse, right? If that comes in hot, the market could certainly pull back. Now, if we get the perfect storm over the next couple weeks, we could crash. All right. Now, I'm not saying we're going to, but if we get the perfect storm, like say CPI comes in hot, or say Jerome Powell says some really bearish things today and we do something like this, right? And then say CPI comes in at 8% or whatever it is. And then the market could do something like that. And then at that point, fear is going to kick in and the market could crash like that. That's the perfect storm of a potential crash happening. If a crash happens, it's going to happen for something like that. Again, I'm not saying that's going to happen. Again, I really don't know. And if we do crash, I'll just buy stuff up. I genuinely would take some fairly large, long positions if the market does something like that. Like I really will. I will jump on those dips very quickly. But I'll have to wait, I think, a little bit more too. So we'll see. But let me know what you guys think, if that's going to happen or not. Last 25 years, Jimmy, we've had the dot-com crash in 2001, where a lot of internet stocks corrected. We had 2008, so mortgage-backed security crisis. We had 2020, which was, everybody knows what that one was about. So in the last 25 years, we've had arguably three. It depends on if you call 2021 or not. Like, it really depends on if you'd consider 2021 or not. I don't know. It depends, right? So, but 2020 looked like this. So, no, my bad. 2020 looked like this. All right, so here's 2020. It depends on what you consider. So it dropped from 340s down to 220 very quickly. If we look at that on a percentage basis, so let's see, it dropped from 340 down to 220, right? So it dropped $120, right? So that's a pretty big drop. 120 is what percentage of 340? It's about 30 something percent, it looks like. Yeah, 35%. So, yeah, I mean, so from this, we dropped 35% in 2020. So, yeah, that's definitely considered a crash. And we dropped, but it happened, it wasn't like all of a sudden. Like, it wasn't all of a sudden. So, yeah. Yeah, I'm going to go ahead and cut my SPY trade. We lost like $10 from it. And again, we were looking to see if we got a bounce, and we just didn't. So it's all good here. Let me cut that. There we go. We lost like $10. But yeah, so we dropped 35% in 2020. If we look at the rest of this year, that was the closest thing we've had to like an actual crash in the last couple of years. And again, I'm not sure what we're going to get. Hey, what's up, Shepard? And maybe we'll do a poll a little bit later to see what we get. We do have Jerome Powell speaking today. And again, I don't think just Jerome Powell comments are going to incite a crash. I don't think that's going to happen. But what I think it could do, again, you got to understand the sentiment of markets as well, where if he says some negative things, it could get the ball rolling on a big drop. And then if CPI comes in higher than expected, that could kind of light the fire, so to speak, and make us really break down. And then, the Fed rate hike decision is going to be on the 22nd. So over the next few weeks, we could see. We could see some big volatile action. I'm not going to say a crash is going to happen, but we'll see. All right, guys. Tesla down there at 192s here. We bought it last at 191s. We did buy 100 shares of TRKA just to have some fun with it. And again, we'll see what that happens. What do you think of the sentiment of the Powell meetings today and tomorrow versus the last few sit-downs he has had? No more jokes and giggly Powell like the last interview. Well, this is a different interview. The last interview was with like a club of some sort, if I remember correctly, right? So the last interview was with like the Economic Club of Washington or something like that, if I remember, right? So some type of economic club. And so in that way, that's going to be a little bit more lax than a congressional testimony like we have today. So today is testifying and interviewing in front of Congress. And so that's a much more formal interview relative to the Economic Club of Washington. You know what I mean? Like we got last time. And so this will be more factual and less opinion based, more factual in terms of what they might potentially do, I think. But again, nobody knows what he's going to say. And I'm just going to wait and see. If CPI, PPI comes in hot than expected, we might go for 50. Yeah, he could go for 50 basis points. I still think it's less likely. I think 25 basis points is still going to be enough to accomplish what he wants to accomplish. But it's not, there's about a third chance, about 30% chance that he's going to do 50. And I would understand if he did. But generally with rate hikes, they're going to do it as expected. And so, that's what to pay attention to. With rate hikes, they're generally going to do it as expected. He's testifying in front of Congress. 10 a.m. It's 7:30 right now, so we got some time. We got a couple hours, 2.5 hours to be specific. All right, guys, market's pulling back some here. Nothing crazy right now. Tesla dipped down some. Look at TRKA. So we bought 100 shares of TRKA. We'll see if we rip up. But we're green on it. Very small green baby trade, but hey, we're green nonetheless. Yeah, TRKA is starting to pop up a little bit. Yeah, we'll stream live. We'll stream the full congressional testimony from Powell. What happened last time JP spoke? Man, I can't remember. Hey, what's up, Ollie? Yeah, well, it depends. Again, like I'll probably buy stuff up if we pull back, but it's going to be small size and we're going to wait. All right, so again, market's chopping sideways. Not Jerome Powell page is hilarious. All right, guys. So market's pushing up to 405. Tesla rebounding a little bit too. I was really thinking about buying a Tesla dip, but the market's mostly sideways, and understandably so. We got the Powell testimony today, and that'll be big. We'll see what happens, but you know that's going to influence markets a lot, and so we'll see. But we'll see what happens. All right, so the SEC is apparently increasing its staff to investigate and prosecute crypto firms. So Jackie Chan plans to leave his $400 million to charity and none for his son, Jay. He explained if he is capable, he can make his own money. If he is not, then he will just be wasting mine. I get it. Like, I understand, right? And that would be true. Aside from the fact that, like, sometimes you need money to make money, you know? And so I might feel kind of upset if I was Jay over here, but I get it. I guess I get it. Do you guys agree with that? I get it, but you know, I'd at least be like, yo, at least leave me like a mil. Come on. All right, so again, TRKA did pull back pretty substantially here. So look at TRKA dip down. Yeah, we're gonna stream the whole thing. Yeah, if honestly I was mad, I'd be mad. What is your biggest swing trading loss in the past? I don't know. I haven't really lost that much swing trading, to be honest. Like, I've lost much more day trading than swing trading. I'm mostly a swing trader, though. Again, I'm green on the year. It's the way I trade is, like I said, the way I swing trade, it's pretty easy to make money. I'm not saying it's easy for everybody, but again, people, the biggest edge you're ever going to have in markets, guys, the biggest edge you will ever have in markets is long-term value investing. Okay. That's the biggest edge you'll ever have. Okay. Bears are going to act like every year the market's going to crash. And if you look at what trends every year in terms of keywords, 2017 market crash was trending, 2018 market crash, 2019 market crash, it'll just go on and on. And so in bears' minds, it's never the right time to buy anything. But the biggest edge you will ever have in the market is long-term value investing. And so again, the way I trade is I look for blue chips. The reason I don't ever lose much in blue chips, number one, my accuracy is really high with swing trading. Like I would say it's at least 70+%, maybe higher. But the reason I don't lose much is because I'm willing to hold those trades for a long time if I need to. I'll hold those trades for years if I really need to. But again, on almost every single one, I don't have to. Like again, I bought Google with that intention, sold Google, in profit a week ago. Same thing with Ford, sold it in profit a week ago. Same thing with Microsoft multiple times, sold it in profit weeks ago. Same thing with Snapchat, sold in profit weeks ago. And so, but again, with all of those, except for maybe Snapchat, I was willing to hold that for years if I really needed to. If that's what it took to make money on it, I would have held it. And so that's one of the ways where I can take short-term trades and make money most of the time short-term. But also, if I really need to get exposure to long-term blue chip investing, then fine, and again, I think the track record speaks for itself. It's not really arguable. Like people are going to say, oh, this dude doesn't know what he's talking about, but like, again, I'm green on the year on Thinkorswim, and me lying about that would get me in trouble. And so I'm certainly not lying. I am in profit on the year on Thinkorswim with my swing trading specifically. Like my day trades have been okay, but my swing trading has been profitable, and I think that's the only thing I really should need to say. I'm not claiming to be an expert or a guru. It's just how I trade, and it works for me, CrowdStrike earnings today. No, I'm not going to stream that, brother. Sorry. Again, it's not a large enough stream. There's not enough people that actually want to watch that. Again, my eyes hurt. I spend so much time in front of screens. Sometimes my eyes hurt, man. Yeah, Bitcoin dipping down some. jpow at 10 a.m. Cara Therapeutics, biotech, I guess. Biotech, penny stock. I'm just not really interested in it. I'm just skeptical of it. I don't know if it's even a penny stock. It looks, yeah. I mean, it's one of those kind of like not quite penny stock, not quite, blue chip, not quite mid cap. I don't know what this is, but it's biotech. High risk, high reward, I'm sure. But like, I think this is probably one of the worst stocks to invest in, because if you look at a weekly chart, like a long-term look at this company, this thing has mostly been sideways for the last 8 years. 8 or 9 years, this thing has been sideways since 2014. It's been sideways. So I don't understand why anybody, unless you want to specifically range trade the sideways action where you buy it at the bottom of that range and sell it at the top. I just don't know the purpose of investing money into it, Now, I don't know if this is a split. I'm looking at the chart in April of 21. It looks like maybe it's split. Or maybe it didn't split. Maybe it did an offering up there, but for whatever reason, it dropped from $30 basically right back down to 12s and 15s. So maybe an offering or a split or something. But yeah, it's just not really my style of trades. If you're in the market in 1929, would you hold until new highs in 1955? Almost certainly not. Almost certainly no. I mean, I would give my son some money. If I was Jackie, I'd give my son some money. I wouldn't just leave him. Like, again, I'd give him maybe like a couple mil and let him live his life with a couple mil. That gives him the financial edge over, and allows him to potentially build his own stuff. And he'd still have to work for it, because like, again, you could, with the exception that he couldn't just retire off of that and never work, right? Like that's probably, I would try to do that, but again, it's hard unless you're in that position, I think. 50K. I mean, maybe buy him a house. Yeah. Again, looking at our poll numbers here. Looking at our poll numbers, 54% are bearish, 46% are bullish. How much is a normal house in Texas? I would say it depends on what you consider normal. I would say you get an average home, maybe like 250,000, 200,000, 250K. You know, for like $1 million, you can get like a mansion here. Basically, you get a big, huge, 6,000 square foot house, depending on where you buy it. Three rooms, you probably get it for like a couple $100,000. All right, guys, so SPY is sideways. Tesla down to 193. Again, I'm kind of tempted to buy this up. I live in Compton, 950K for a home. Yeah, we're going to stream the whole live, guys. Don't worry. Yeah, you can get okay, to put that into perspective, you could get in Texas for $1 million, you could get like 15-acre compound out in the country somewhere. Now, it's not going to be in Houston, you got to find one out in the country, but you could probably get like a decent home in the country, like a decent little 10+ acre place. All right, so Richard Hart has removed his $1 billion+ crowdfunded crypto projects Hex and Pulse Chain and PulseX from his bio. He also tweeted he is deleting his Insta. The SEC is coming. All right, guys. Again, SPY sideways here. We're not really doing too much. Yeah, that might be true, Sal. No, you're not going to be able to mow. I mean, you get a riding mower. It's kind of fun. Yeah, I've never heard of it. I don't know much about it. Again, I'm not saying to buy Hex. Hex seems kind of shady from what I can see. Like, I buy crypto, but it's mostly just the big ones, CrowdStrike fourth quarter earnings after market close today. I don't know, with CrowdStrike, like, I'm not saying it's a bad company. All right, like, I'm not. Everything's down on the year for the most part, except for this. So this is down on the year. I'm not saying it's a bad company, but it's what I would consider a mid cap. I think the risk and vulnerabilities for stuff like CrowdStrike is that like interest and view count can fluctuate very quickly. Like everybody might use CrowdStrike now, and then they use a different website in 5 years, and so that makes it incredibly vulnerable in that way, I think. Oh, never mind. CrowdStrike. I was thinking of a different business. So CrowdStrike is a cybersecurity company. So my bad. I was completely wrong there. CrowdStrike is a cybersecurity company. So yeah. So again, I don't know much about this one, to be honest. Maybe it does some things. It delivers incident response, tech assessment, training, and advisory services that help you prep against advanced threats, respond to widespread attacks, enhance cybersecurity. Yeah, I mean that's cool. But when I look at earnings, I always look at the graph, like specifically the EPS graph is where I like to look at it. And so here's the EPS graph for CrowdStrike specifically. Yeah, CrowdStrike is just not profitable as a company. Yeah, I mean it's lost money every year since 2020. Yeah, so in that way, I don't trust it at all. If it can't make money, what's its revenue looking like? Revenue's getting better and better, so that's optimistic. So it's got about 580 million, 535 million, 488 million. I mean, this is a good revenue graph, obviously, so it's got some potential, but it's still not profitable yet, which means that, like, I don't know, like if they're making this much money, I guess this is the way I have to look at it. It's a software company. If they're making this much money, and it's not a huge amount, like, again, quarterly they're making about 600 million every quarter, so it's a decent amount, I guess. But if they're making this much money and they're still finding it hard to profit, I'm skeptical of CrowdStrike long term. Now maybe when they finally break profit, that's great. But again, it looks like they've got monetization and profitability issues. So, and again, I don't know enough about them to really know. So I really don't know here. Let me know what you guys think. Why is Tesla breaking down? Tesla's at 193s now. I mean, look at a 20-day chart. Tesla's been pretty flat. Now, maybe it ends up rebounding back, but right now, this is basically the 20-day chart for Tesla. Each candlestick represents an hour. The lows are 185, so it's been holding firm, but part of me wants to buy the dip, but again, I'm not really buying anything right now. Jerome Powell speaking over the next couple of days, followed by Jerome Powell speaking, plus you got Jerome Powell speaking, you got CPI next Tuesday, you got there's a lot of stuff happening over the next couple weeks, and so in that regard, I'm a little bit skeptical to buy anything right now. I'm going to let Jerome Powell speak first and see what he's got to say, see what the sentiment looks like. There may be some trade that you can get involved with like, if he says some good things today, maybe some bad things tomorrow, or vice versa. I don't know. Mickey D's is good. Thing is, that business model is real estate royalties, and if real estate goes down, I don't know how it will affect them. Yeah, all good, Denise. Yeah, I'm out of Google too, Flames. I mean, it looks like you took that trade with me, bro. Again, I don't want people to copy me, but hey, congrats, man. We can celebrate, bro. You know. All right, guys. So TRK, pull it back. SPY is right around the volume weighted average price, right at the VWAP here. All right, guys. So again, Tesla dipping down. Are you guys buying the Tesla dip? I don't know if I am yet. I'm waiting. Yeah, TRKA up to 90, SPY up to 405s, 80s, every Tesla looking rough. Yeah, Tesla dipping down. Are you guys buying Tesla, I guess? Again, I'm waiting for the speech to happen too. What's the deal with people getting weird with me about using a 1-minute chart, bro? Like, y'all realize I'm using a 1-minute chart just to show you guys the close price action. Like, if we're watching for market reactions here, are you going to look at a market reaction on a 5-minute or a 10-minute or a 15-minute chart? Of course not. Like, you're going to look at a 1-minute chart because 1-minute charts show the most recent price action, you know, the most up close price action. Are we really, do y'all think we're really basing our trades off of a 1-minute chart and on for our swing trades? Of course not. You know, what a ridiculous thing. Like, you know, they're mad. Buy more Tesla at 150? I don't know, bro. Maybe. Yeah, for sure, Chris. Internet's weird, bro. But it's like most of the time with swing trading, again, I'm going to tell you this. Do not use a 1-minute chart for swing trading. It doesn't mean anything. You're not even going to be able to analyze a 1-minute chart, I think. Like, I can't swing trade off of this. I'm looking back on my swing trades. When I'm swing, most of the time, my favorite chart, and let me know what your favorite chart for swing trading is. Most of the time, my favorite one is like a 20-day chart. Like, you'll see me bring this one up to analyze the price action. And really, for my swing trades, I think it's the most relevant. Like, you want to use the time frame of the chart that you're looking at the price action on, right? So if you're looking at price action over a 20-day period, use a 20-day chart. If you're looking at it over a yearly period, depending on how long you're holding your trades, then look at a yearly chart. I'm mostly using like a 20-day. Sometimes I'm using like a 4-hour. Sometimes I'm using a daily or weekly. It just depends on what we're looking like. It depends on what time frame we're watching it. I see more potential downside on Tesla based on an oscillator. Maybe. We'll see. Apple is the last domino to fall. Again, I think it's going to be something where, if we do have big pullbacks, it's going to be something like Jerome Powell says negative things today. He says negative things tomorrow. I'm not saying this is going to happen, but it could be something like bad things today from Jerome Powell, congressional testimony, bad things tomorrow with House testimony, and then CPI on the 14th, next Tuesday, and exactly a week from now comes in high, and then that spirals the market to the downside. I think that could happen. I'm not saying it's going to, but it certainly could. I don't know what are the probabilities, like what are the likelihoods that you think that's going to happen to you? Like what are the odds that you think that is going to happen? I don't know. I'd give it maybe like a 1 in 4. I would say maybe like 25% chance that happens. And again, I think if we do spiral down, I think it might look something where we're going to hit like 370s. Tesla just broke lows. So I'm really kind of considering buying this up on a short-term day trade right now. But imagine if John went all in at Tesla at 100. Oh, I would have made 100%. Yeah, 4 hours are nice. I like 4 hours too. 30-second Eddie, great idea. Yeah, chart should match the time frame, 100%. John, are you looking at Amazon? I don't know, man. See, my daughter made fun of me. She said I go too much the other day. I was watching her softball game, and I had to teach my daughter. I was like, hey, look, you got to run through the bases. My daughter, she hits the ball, she runs to first, and then she slows down when she got to first. And then she got out one of the times on her last games. And so then I saw her doing it again. I go on stream, and she made fun of me for it. I told her you got to just run straight through first. It's the only base you get to do that. Tesla just broke down. It's at 192.40s. Amazon at 93s here. What does the daily chart look like? I mean, I don't hate Amazon right here, to be honest. I think Amazon has pulled back relative to a lot of other things. It hasn't really gone up with the market a huge amount. And so I think Amazon's interesting. The problem with Amazon is the PE ratio long term. If you're looking at Amazon long term, the problem is the PE. I see a beach. No, he doesn't always crash the market. Yeah, I was wildly wrong about Tesla for sure, Only 25%. I think 25% might be, again, it could happen for sure. But I think 25% is a fair amount. Dude, I was really thinking about buying Tesla just now. You guys heard me say it too. I just didn't end up actually buying it. I thought about it. Yeah, I always buy panic dips. It's my favorite trade. It works too, Fair value Amazon, $50. All right, guys. Tesla bounced it up. I should have bought the dip. John, what percentages are you looking for in your swings? I mean, it varies. It depends on what the stock is. Some stocks have bigger ranges and move in bigger percentages than others. So it depends on what the range is. Like, for instance, Ford, I was looking for a much smaller percentage because it has a much smaller range relative to like Google or, whatever, Tesla. So it depends. Man, yesterday was brutal. Market bumped up yesterday, right? Yesterday was pretty flat, it looks like. Actually green relative to where we opened up yesterday. Yesterday we opened up at about 405. Today we are at about 405.20. So we're a little bit green relative to where we were, I think, right? John, you scalp trade? Sometimes, man. It depends on what we do. Like, I don't really have one specific type of trade, I guess is the easiest way to put it. Like, I scalp stuff sometimes. I swing trade, I invest, and I day trade ranges and trends. So honestly, I kind of do a little bit of everything. I don't restrict myself to one style of trading. I think looking at it in one way is usually the wrong way. I think that, like, I'll buy up stuff, extended moves on the downside short term for day trades. I'll scalp momentum as well. I'll swing trade for sure, and then I'll definitely invest as well. So I do a little bit of everything, and honestly, having that freedom to do whatever I want to do, whether I want to swing trade or invest, helps me make money, I think, because I think if you look at things only in day trading terms, it's harder to come out ahead sometimes, Where's the textbook head and shoulder on what time frame? Bull. Wait, what's the time frame? Powell's at 10 o'clock. Tesla will be 250 by the end of the year. Maybe. All right, so pull it back to the volume weighted average price here. All right, guys. So Tesla rebounded, man. I should have bought that dip. Honestly, I really wanted to. I'm still kind of bummed out I didn't. But again, Jerome Powell speaking today. Congressional testimony. So we rebounded a little bit. We're still at TRK. I kind of wanted to buy the SPY dip as well. All right, so TRK pulling back a little bit. Tesla should have bought the dip at 192. SPY rebounded, basically following Tesla. Where's Apple at right now? Apple was right around that previous closing price. SPY is a little extended relative to Apple. What's up today? Is it Microsoft? Okay, so it's Microsoft breaking high. So here's what's going on. Here's Microsoft right here. So Microsoft's pumping up to 258. Man, when you're right, you were right. Should have held it, but it's all good here. No, the actual Jerome Powell meeting, it's 8. We still got a couple hours. I'll put the timer up here so people could see it. So yeah, right now it is 8:12 market time. So we've got about an hour and 47 minutes and 30 seconds. Right around this is how long we got. But yeah, look at Microsoft bounce. Google at 96 is here, man. Microsoft, again, to put it into perspective, guys, like to put it into perspective, let's talk about this. All right, so we got into Microsoft at 240s. At 240s, we got into Microsoft. We got into Google at 89s, 90s. We got into Ford. Ford is right now, where's Ford at right now? Ford is currently at 13. We got into Ford at 1220s, 1230s, I believe, is what we got into that one at. We got into Microsoft multiple times, too. So, hey, you love to see it. You love to see it. Let's see if we can keep the swing trading profits up here. But, yeah. I think if I do have to critique myself for swing trading a little bit, I think I need to hold these a little bit longer. I think I should be a little bit more patient with these relative to where I was. But again, my accuracy like justifies it. It's one of those things like the longer you hold trades, the lower your accuracy is ultimately going to be a lot of the time. So. SPY dipping down a little bit. I might buy this dip, but again, I think I'm going to wait. My only worry, natural gas. A lot of we got out of natty gas too. We made some money on it. We bought natty gas last time at 7s, like 750s. We sold it like 830. But we haven't entered it since then. Where's it at right now? Natty gas is at 870s. It's a little bit too high for me. Is Meta still ripping up? Tesla pull it back down a little bit. Here's Meta right now. So yeah, Meta almost up to 190s again. Part of me wants to buy the SPY here. Look at Meta rip up here. SPY just dipped under VWAP here. Pull it back to 405, which is probably a decent psychological level. I don't trade on Robinhood, but I got a huge chunk of my savings parked in there collecting 4.15% interest. Hey, good luck, man. Yeah, Jerome Powell speaks at 10. You called Microsoft at 240s last week. I forgot I bought on my other account. Just sold. Thanks for the reminder. Hey, no worries, man. Yeah, again, it's one of those things like we made a Twitter post. It's like they can't critique our trades because they know we've been right about it. And so they critique our time frame. They critique our bias. Like, it's all good, man. Like I said. You better believe we're gonna rub it in their face every chance we can. You know. All right. So part of me wants to buy this dip at 405s on the SPY. If I do buy it right now, which again I'm considering, if I do buy it right now, I'm gonna have to get out before the Jerome Powell press conference. I'm not gonna sit in this when Jerome Powell speaks to Congress. I think that's a terrible idea. And maybe we'll day trade some when he does, but again, in terms of my swing trades, I think it's a terrible idea. That's 9 Central. Dramatic. Yeah, again, I'm not buying anything right now. I think we might pull back a little bit. I've been kind of sitting here, not wanting to take any huge position ahead of this. You know. Here, you gotta. Yep. Don't. Kara, you gotta karate chop it. There you go. How you doing, buddy? Love you, buddy. You see? Yeah, your eyes are looking good, man. Love you, bud. Have a good day at school, man. Do you typically buy against the trend? It depends. Like what I usually do is like I look for big extended stocks to pull back. I look for big stocks, blue chip stocks to dip, and then I buy the dip. Is usually what I do. So a little bit like I buy pullbacks is essentially what I buy. So it depends on how you look at it, but it depends on what trend you're talking about. Like there's multiple different trends. Again, to put this into perspective, right? So we can look at the SPY, and here's the best example to use here. So we'll put the timer up right there. But you could say don't buy against the trend, right? So here's one trend that you can see, right? So this trend right here is the last like 6 months, essentially. And so there's that trend. We can zoom out further here and look at the longer term trend like this, where it looks something like You know what I mean? Like there's that trend right there, which is kind of like widening, to be honest. But there's that trend as well. You could zoom out even further and look at the longest trend to really look at here. And again, that's on the upside. And so I think it depends on what trend you're talking about. Like that trend goes like this, basically long term. So it depends on what trend you're talking about. Again, I think a lot of the time people use trend to confirm what they want to happen. So it's like if you're short, you're going to say, oh, well, we got to look at the long-term trend, right? And what they mean by long-term trend is the daily chart, because that's the most favorable one to their direction. Meta just broke highs as well. If you're long, a lot of the time you're going to look at either this trend right here, which is, I think this is the most obvious trend currently, which is this side. I think we bounced directly off of the bottom. I think this trend right here is the clearest trend to watch. I think that's the most obvious trend right now. And right now we are essentially in the middle range of that trend. We are right in the middle of it. And so again, I don't necessarily trust it right here. It's middle range. It's probably the worst time to buy stuff for me. But we got some catalysts over the next couple of days that might influence my positions. And again, I really have no idea what's going to happen. But again, it depends on what trend you look at. Which downtrend though? See, that's my point. Is that like, again, I think the clearest trend is this one right here. I think this is the one that's been confirmed the most. What's the downtrend what downtrend are people referring to? I mean, I know you could look at like say this trend, but I don't think this is the most obvious trend right here. Like you could say this is a trend. Like let's just draw it really quick. Like you could say this is a trend right here. Hold on, let me fix this. It's not the best one. You could say this is a trend here. You know what I mean? But like what downtrend are people referring to? Like I said, I think people are trying to confirm their bias. But I think there's lots of different trends and lots of different time frames. And I think it depends on which time frame you're looking at. But again, I'm more than welcome to listening and hearing about other directional trends that people are talking about. But what's the downtrend, I guess? Yeah, shorts can cover in pre-market and after hours. Yeah, this trend. Yeah, I mean, this trend was going like this for a while. Like, look. But that trend now broke here as we broke out of it here. Now we're looking more like that, and so it depends on which trend you're talking about. Like I said, I think we could go either direction here. But the yellow line is the 200 EMA, the 200 exponential. I think I have the anchored VWAP up here. I'll have to adjust it though. But I'm talking about looking at actual trend lines, not using just the VWAP on a longer term basis. The VWAP's cool and all, but I think you got to look at, I think the easiest way to look at it, I think that indicators are good for short-term price action, but I think the longer you zoom out, the less relevant technical indicators are, to be honest. And I think that's a very well-known thing in trading, is that like the more you zoom out, the less relevant technicals are. The more you zoom in, the more relevant technicals are. So if we're looking at a yearly chart, I don't know how much technicals are really going to mean anything, to be honest. Like I don't think technicals mean much over a year's period of time. And again, with specific indicators, I'm a big VWAP fan. I love using the VWAP intraday or even for swing trading sometimes. But I think, again, the longer you zoom out, the less relevant technicals are. Because again, with technicals, you're essentially looking for self-fulfilling prophecies, basically. Like you want to try to see what everybody else is doing and then copy that. And one of the reasons the VWAP works intraday is because a lot of people use the volume weighted average price intraday, right? So it's like when the stock pulls back to it, a lot of other traders see that pullback and they buy the dip, and then it kind of fulfills itself. And technicals work because other people think they work. And so, you're basically betting on psychology. But again, with something like the anchored VWAP over a long-term period of time, maybe it's useful. Again, I'm not hating on it. I don't really know. I've never tried using it long-term. But I will say, in my opinion, and maybe I'm wrong here, I could be wrong, but in my opinion, the longer time frame you zoom out, the less relevant technicals as a whole are. Now, we can look at trends. I think trends are still relevant long-term, and I know that's still considered technicals. But what I mean is, like, technical indicators are less relevant the longer you zoom out. I think you can look at extensions, which I guess is considered technicals. But I think the only technical thing to look at long-term is trend. And again, maybe I'm wrong. Yeah, sideways is definitely a trend. No, PDT rule does not protect investors. PDT rule is terrible. It basically forces new traders to if you want to day trade and you're new, it forces you to do it with $25,000. And so, again, it's terrible. It forces new traders to trade really large in the beginning because it's trying to protect them. It's like, nah, man, you tell somebody, hey, you can only actively day trade if you got 25K or more. What do you think people are going to do? Certain people are going to take 25K and trade with that. And now you're basically making a brand new trader that has no risk management skills day trade a $25,000+ account. It's a terrible thing. The only people the PDT rule are really protecting are the banks. They're protecting your brokerage and the banks associated with it. That's the only people they're really protecting. It's certainly not helping the trader. If you really think about it, having no PDT rule would help a trader more, right? Allowing somebody to actively day trade with a couple $1,000, small risk. If you lose, you're only down a couple thousand. That is much more beneficial for a new trader than forcing them to take 25K to do it. It's ridiculous. It's silly. It's just a barrier of entry that protects the banking system and everybody else. Like, that's, again, the PDT rule is ridiculous. Do you use the 400 SMA? No, not really. New watcher here, currently holding a Tesla put. Just wondering if you have any advice on Tesla for today. I really have no idea what Tesla's going to do. I don't know what's going to happen. Yeah, I really have no idea what's going to happen with Tesla. I think, we can only look at time frames, and again, we could look at this, but 20-day time frame is pretty choppy for Tesla, so it's pretty neutral. It depends on what Jerome Powell says. 90-day time frame, pretty neutral over a 90-day period of time. So we've gone up and down in big ranges over that period, but we're still pretty flat. So just be careful, with Tesla. I really have no idea what it's going to do. We're holding a little bit of TRKA, but we're pretty flat on it, I think. Yeah, we're almost completely neutral there. Natty Gas breaking down. Yeah, Natty Gas is too high for me right now. I swing traded it when it was at like the 7s, and then it ripped up to over 8s, and now it's at whatever it is now. It's just not something I want to buy. Doom soon. Yeah, well, people have been screaming doom and gloom in here for the last 6 months, and they've been mostly wrong. Not saying it's not going to happen, but at a certain point you start tuning it out. So FTX lawyers and bankers billed them $38 million plus expenses for January. I Meta dip down here. Tesla's still at the lows. SPY right in this, right under that 405 level. Again, I didn't end up buying it. We're flat here, you know, so. I have to go make myself some more coffee, guys. All right, team. So it is 8:30 market time right now. We got the Jerome Powell stream in about an hour and a half. About an hour and a half. Let me know if you guys think good or bad stuff's going to show from this. All right, guys. All right, team. So SPY back over 405s, bounced a little bit right at that level. Market is back up to 405s here. We still got about an hour until the market opens. Market is ripping back up. I should have bought that 405 dip. I stopped myself from buying it, but it's okay. All right, so yeah, Fed Jerome Powell speaks in about an hour and 25 minutes. Look at Meta rip here. We got Tesla down at 190s. Maybe I should have bought the bottom of that range here. And again, sometimes these little range-bound trades on a short-term basis can be powerful. Like sometimes just waiting and then buying these dips down here when you can kind of see, like you got to see this trend. And essentially, like you got a little bit of a chance, like you got higher than 50% chance that you're going to bounce back up once it confirms that sometimes. So it can be powerful here. Look at Meta up there at almost 190. Let's see if we have 190 today. But it's trying to get up there. Again, does this help or hurt the market? I love how people saying the economy is going down. Well, I think, okay, again, people act like I'm just super bold, but I'm not. And like, okay, here's the logic, right? Generally, when we have rate hikes like we do now, and when we have inflation like we do now, generally the market needs a recession, is what happens. So like generally the market needs a recession in that regard. Because of that, right? Because of that, a lot of people think that we still got some down to go. A lot of people think we still need to drop here, essentially. People basically, they understand that we still need to pull back some in their head, right? And in their mind, we still got to pull back some. So that's the justification for a market crash or a market drop, right? Now, there's some other arguments for the upside as well. Like one of the arguments is like basically that what we're in now, like the reason we have high inflation now is because of 2020, right? And essentially we've already done that part. We've already dipped and had, what some would consider a crash already, right? If you look back at 2020, here's 2020, and we rebounded completely from that. And if anything, the inflation problems could, look a little bit more obvious up here. But it's one of those things that's arguable. We've already been pulling back. The market has already had broad pullbacks to where some people would already consider us already having a recession already. Like the definition of a recession, I believe, is 2 consecutive GDP losing quarters. And so, if you go by that definition, two consecutive quarters of decline in a company's GDP, right? And so we've already had that, right? We had that for 2 consecutive quarters. Last year, we had that, right? And so it's already arguable, and when they look back at history, they might say, hey, well, we already got that, So, and if it's like that, then it could be arguable that we don't need to do it again. But again, you do need stagflation. And so there are some chances that we do pull back this year. A lot of people think we will. But it's not a for sure thing, like it hasn't happened every time we've been in this situation. And so, again, it's not a for sure thing. It could happen. And the way I look at it is that it could happen. It might not, and I think the more I hear people say, hey, we have to do this, or we have to do that, or we're going to do this, the more I lose credibility for them, right? The more I think they lose credibility in that regard, because anybody that really understands the market understands that we don't have to do anything, and especially with the situation we are in now, I could say it's certainly possible. Some would even argue that it's more likely than not that we pull back some, but it's not a for sure thing. Yeah, catch it back up with the chat. What am I saying? I think what I'm saying is pretty simple, Heavy. What I'm saying is that we don't have to crash. The market doesn't have to crash. That it's already arguable that we've already been in a recession, and that, it's possible we do hit it. And I think, again, if you're mad at me for saying that we don't necessarily have to crash, I think you're getting a little bit too emotional about it. I think that nobody knows what we're going to get. And again, I hope we don't. Maybe I'm just being optimistic. But if we pull back big, I'm not going to stop. I'm not going to let this stop me from buying stuff. Even if we do crash, again, we usually rebound within a couple years. Every crash, we've rebounded within 5 years, I think, except for maybe one. So even if we do crash, unless like retirement in your life is imminent, like is coming up quick, then the people who lose the most are people who sell and get emotional about it. I'm not talking about you specifically, Heavy. Stop being mad, bro. Post-pandemic creates growth, maybe. Meta's trying so hard to potentially make a double top. Yeah, Meta's ripping up. And I don't know. I've kind of changed my mind on Meta. Originally I didn't like it, and I still have some I'm still skeptical for it, but I think their marketplace might be the silver lining that helps them still do really well. Now, the metaverse, I think they've been a little bit wasteful in that spending, but hey, what's up, Guts? Hey, what's up, Miller Time? Hey, what's up, man? Stop being so angry, Heavy. Stop being so angry, man. But no, I don't think there's anything necessarily against shorting, Ben. I think shorting is fine if you want to do it. I think people underestimate how risky shorting can be, though. I think shorting can be incredibly risky, and I think a lot of people look at shorting as a moral issue. It's really not. Like, most of the time, the companies that are getting shorted the most are terrible companies where it's just kind of easy money to short them. Now, sometimes there's risks that come with shorting them, like they can get squeezed out. But shorting the market, again, I'm not really mad at it. I don't think it's necessarily, I know over the last few years they've made it a moral issue, and I don't necessarily agree with that. I think you should allow people to try to make money whatever way they can, but if they get squeezed out, it's on them. I mean, is that actually happening though? Dramatic? Yeah, Snap popping up. Let's check out Bruce. Bruce is good, man. Bruce is getting big. I don't know if I have any new pictures of Bruce. I might. Let me see. Yes, I mean, Snap is up big, man. It's up to 12s. And again, we were talking about this one at 7, 8s. Last time we bought it was at 10s. Let me look at the trades here for this one. We've had some fun with Snapchat, man. We made a bunch of money from Snapchat, too. We buy it at the lows, sell it at the top. If I do have a problem with it, it's getting out a little bit too early. But yeah, like, look, this is how I trade Snap. If you guys want to see it. Like, you can kind of see how I do this. Right, so I haven't really messed with Snap over in a while, but like people like Snap has been really profitable. Again, we buy it at the lows here, and then we cut it at the top. We got out literally at the very top last time at 12.17. Same thing down here. We start scaling in some size. We sell on the dip, and again, you can kind of see like this is a beautiful example of my emotional dip buy strategy about how we buy emotional pullbacks. In companies like this, right? And this is one of those companies that, for whatever reason, people just absolutely hate it. I don't know why. Like, I really don't know why. But again, you can kind of see big emotional pullback. What do? We start buying stuff. We buy it up after that big dip. We take profit after the bounce. After only a couple of days, you can see this one bounced from 8.60s. We sold at $9, basically $10. Same thing here. We buy it down here at $9.99. We sell it at 12s. Again, you can kind of see each time, big emotional pullback. That's when we start to buy it up. Big emotional pullback. That's where we start to buy it up. Again, it works really well. And again, these are relatively small trades, but Powell starts his speech in about an hour and 15 minutes. All right, guys, Meta's still ripping up. Tesla right at the lows here. Part of me wants to buy this little dip in Tesla short term, just because we've broken down here and bounced here over and over and over again. I don't know. When you called snap at 8, I loaded up on that emotional pullback. Probably my biggest gain I made in the past 12 months. Good call. Hey, thanks, man. I appreciate the support, bro. You know. Yeah. Again, what Wall Street Journal says is that Powell's going to likely caution on Capitol Hill that strong economic activity could lead to the Fed to raise more interest rates than it expected. And so if he does that, then maybe we'll pivot to 50 basis point expectation. Again, maybe, we don't know, but that could be something that we get. Where's the S&P 500 going to end today, guys? What do you guys think? Is there news on Snapchat? Speaking of Snapchat, Salesforce announced Einstein GPT. It creates personalized content across the Salesforce cloud with generative AI. And they had really good earnings a few days ago. Here's CRM. CRM had great earnings. They had one of the best performing earnings reports all earnings season here. They ripped up from 160 to basically 195. Boeing starts production of the MH1391 Grey Wolf. Deliveries to the U.S. Air Force expected to begin in 2024. Lawmakers are reportedly going to reintroduce a bill to reform the way crypto is treated for tax purposes. Yeah, Snapchat. Let me look. Yeah, so it's a new bipartisan Senate TikTok bill that's going to be unveiled today. I don't think this has any chance of going through. I really don't. I don't think this has any chance of going through. And so you might see, like I said, personally, maybe I'm wrong here. And again, as you guys always know, I have no idea what we're going to get here. But I don't think this has any chance of going through. I think, to be frank, I think TikTok's just too big at this point in time. It's too large already. There's too many people that use it. It would be very different for them to ban something like this. And I understand why they want to, but I just don't think it's going to happen. Did they really? Canada? Yeah, but it's only on Gov devices. So it's only on Gov devices. So basically, like, because it tracks you, government officials can't have it. All right, guys. So we're pulling back down. We're at 405s right now. 405s. Market pulled back to 405s, mostly choppy action, and I'm only assuming that this is due to the Jerome Powell conference. Yeah, we're going to stream the full Powell speech. I'm going to put this up. Yeah, so the full Powell speech is going to be streamed live here at 10 a.m. Sub to chat. Yeah, but I mean, the Canadian dollar, I understand taxing, but 52% is a little excessive, in my opinion, for me personally. I think 52% is a lot. But you guys also have to understand it's marginal, you know? Like, a lot of people don't understand it. I'm not saying, I think you understand it because you said anything over 250K, but a lot of people need to understand that type of tax is marginal. It's a marginal tax rate. So it basically means that you get taxed in your bracket up to 250K, and then anything you make over 250K is then taxed at the higher bracket rate. Or the higher rate. That's kind of what that's what it means. So it doesn't mean like all your income. So like I'll put it this way: you make $251,000, 250K of that is going to be taxed at the lower rate, and then 1,000 of that's going to be taxed at 52%. So you're going to have to give up, 400. You're going to have to give up the $1,000 afterwards. You would make $480, and they would keep 520. If that makes sense. That's what it would do. That's what it means. $1 is 1.31 Canadian. Yeah. Yeah, I remember going to Canada and buying a cheeseburger at McDonald's, and cheeseburgers were more expensive. But again, it's in Canadian dollars. My stepdad's Canadian. I've lived in Canada before. They've got loonies and toonies and Timmy's. Canada's beautiful, man. It really is. Like where I was, at least. I was at Batchewana Bay and Sault Ste. Marie, Ontario. Beautiful country, man. It really is. And during the summer, let me clarify. During the winter, it's pretty too, but it's hard to get around. But I love Canada. I really do. Canada's cool. Super nice people too. Rivian Automotive Attention is going to offer $1.3 billion of green convertible senior notes due in 2029. All right, guys, at 405s for the SPY right now. Again, everything's very, very, very sideways leading up to the Jerome Powell testimony. And my assumption is that the opening bell is not going to be much better here. Again, if you look at what Tesla specifically, generally a very volatile stock, has done over the last couple minutes, we are very quiet, very sideways. The SPY as well. Here's the SPY, basically. So we're not getting much volatility right now because, again, most people are apprehensive because of the testimony from JP. So, yeah, we'll see what happens. But I know Meta has been moving a little bit this morning. Meta's been moving up big. Again, here's the SPY on a 20-day chart. I think the trend is obvious on a yearly chart, though. But I mean, I never got a response. And I think my guess is I didn't get a response because people understand that like this trend is clearer than whatever downward trend they were looking at. But what downward trend are people referring to? Like, again, if you look at the last year, I can understand saying we're down on the year. And again, if we zoom out of this, I guess you could draw a trend line around that. I don't think it's going to be the cleanest trend, though. I don't think it looks like the cleanest trend here. I guess we could say that's a trend, and it's not bad. Let me get that out the way, I guess. So I guess I could see this trend here if this is the one people are referring to. They're gonna let me move it? No, they don't. Let me fix that. But I think it's got to be like that is probably the better trend here. And again, if this trend is accurate, right? So if this is the trend we're actually in here, then by this logic, we're going to start to pull back some here and come back down. If that's the case, you can kind of see that trend here. And again, I'm not sure what we're going to get. Let me know what you guys think. Let me look at the poll numbers today. Hey, what's up, Kelly? Boyle, it's down 80% past 3 months. Buy target under 5, good money. What's Boyle? What is Boyle, I guess? Like what's the underlying asset of Boyle? Well, raising rates is going to cause short-term pain. It doesn't mean it's bad, though, because some people are going to argue that we need that short-term pain to combat inflation, and to a certain extent, they're right. Natty Gas. Yeah, but what's the nuance of this? This thing has dropped from 120s down to 611 right now, $6. And I guess UNG has as well. Yeah, I mean, if I buy something, though, it's going to be like UNG, Boyle is pretty down there, too, though. I guess it's arguable. The question, is which one has the safer range down here at the bottom of this daily chart? I don't know. Hey, nice, Kelly. Yeah, I'm in TRKA right now. We bought 100 shares of TRKA for fun today. We'll see how that one goes. I could buy some Boyle here. Like I said, the question is what's my risk in this trade? I think there's an argument for like a small risk. 25 shares would mean that if we dropped from 6 down to 4, we'd be down $50. I think that's a reasonable risk. I might buy a little bit down here too for Boyle. Reasonable risk, I think. I think there's an argument for it, but yeah, I'm not taking 1,500 shares. I'm not buying 1,500 shares of anything, and I have the buying power and equity to do it, but it's just too risky in that regard for me. Oil is a decaying asset. Yeah, I'm not used to trading these commodity-based ETFs. What do you mean by that? Again, it's not really my style. It looks extended, and if it's based off of a commodity, you could assume that we're going to rebound back up some. But what do you mean by decaying asset? Again, like I said, I always try to be honest with people. This is something where I don't have a ton of experience buying these type of commodities. Oh, wait, this is an inverse? Yeah, is this inverse? I know I was in UNG, and I made some money on UNG over the last month or so, but not a ton. He speaks in an hour. There might be a timer in the top right of the screen that has a countdown telling you when the speech is. There might be, could be, possibly, might be. You think about gold? It depends. Depends on what your plan is with it. All right, guys. Tesla dipping down pretty big, down to 191s here. You guys buying this dip? Again, we do have Jerome Powell speaking today, and that might influence this. So are y'all buying the dip here for Tesla? Are you guys buying this dip? Let me know. All right, so looking at our votes, we got 56% saying no. The SPY does not close green. 44% say yes. And if we look at the actual SPY chart here, we're right at that previous closing price level. So it's an interesting spot here where we're close to the previous closing price. So we're close to the red to green level. Crypto is popping hard right now. I'm gonna good luck, man. I hope you make some money. Let me see Bitcoin. Bitcoin at 22.3s. All right, so remember, guys, it's kind of a big week for economic activity. Just to put this in perspective, we got a lot of stuff going on this week, guys. A lot of stuff. All right. So this week, this week, obviously, we got Jerome Powell testifying in front of Congress today at 10 a.m. We're going to stream the entire full thing completely live like we always do. We've got wholesale inventories dropping at 10 a.m. as well. Not the most relevant thing. Then tomorrow, we've got some stuff coming out. So we've got import-export prices tomorrow. We got Jerome Powell speaking again at 10 a.m. with the House testimony. And then we've got the JOLTS job openings report for January coming out at 10 o'clock tomorrow as well, right around when Jerome Powell starts speaking. We also have the Bank of Canada interest rate hike decision, which is not really going to move markets some, but it'll move markets a little bit. We also Thursday have jobless claims numbers. We've got jobless claims. We've got Vice Chair Barr speaking, and then we've got the Challenger job cuts as well. So Thursday we got jobless claims, and then Friday we have both U.S. and Canada unemployment rates. So we've got unemployment rate for U.S. and Canada as well as non-farm payroll numbers for Friday. And so tomorrow we also have, just to put this in perspective, we have non-farm, I believe it's, let me see what it is tomorrow. But yeah, so Wednesday we actually have non-farm data as well. I forgot this. We got the ADP non-farm employment change tomorrow. Again, dropping at 8:15, and then Jerome Powell speaking tomorrow at 10. And again, Jerome Powell speaking today at 10 as well. You can see the timer in the top left. So that is all the stuff we got going on this week. It should be a big influential week. If we do get some big volatile price action, it's going to be from all this data coming out, as well as Jerome Powell. As well as Jerome Powell. Disney. I mean, I think Disney is just one of the easiest buys. I think when Disney is very cheap, Disney's got a lot of haters. You know what I mean? And so I think when Disney's cheap, I think people underestimate the strength of Disney because of political bias most of the time, right? But I think Disney is incredibly strong, owns a lot of different assets. It's going to have a lot of big movies coming out like Star Wars, Marvel. They own ESPN. The Disney World makes bank. I think I think Disney is one of the stronger stocks long term, and I think people underestimate it because of again, political differences and ideology differences. But I think yeah, speech starts in 55 minutes, 52 minutes, but yeah, basically. Yeah, I cut most of my swing trades because of risks in that regard too. I'm thinking of some swing trades and growth stocks. Any suggestions for me personally? So I only do it with blue chips, right? So I can kind of see it. It creates some it creates some enemies for me because I'm just hesitant to swing trade penny stocks. I'm hesitant to swing trade mid caps, and I think mid caps and penny stocks have like I think they're the stocks where like people who invest in them turn into like huge fanboys of the companies because they're so desperate for them to go up, right? And so whenever I come along and I'm like, hey, I don't really like doing it, I think it's kind of a sucker's bet, people get weird. But my point is I only do it with blue chips. And right now I think blue chips are a little bit too extended on the upside for my taste for doing it. Like I think blue chips are a little bit too high. Like I'm not buying anything right now. I just think it's too risky. All right, so SPY right at the previous closing price here. Meta at 188. What is the future, John? No idea, man. Pretending to buoy on other leverage, ETFs prices tend to decay over time, and triple leverage will tend to decay at a faster rate than 2x leverage. As a result, they can tend towards zero. Okay, got you. Before this happened, leverage ETFs can undertake a reverse split, creating higher price shares but reducing the number. Got you. Okay, that's why there's risks in that. Okay, got it. Makes sense. I don't really trade commodity-based ETFs like that, though. And so that actually makes sense. I appreciate the update. I'll probably end up cutting this now. I don't like it then. Because if we look at it in terms of like base extension, that's one thing. But if this thing is just going to get worse and there is a likelihood of it going to zero over time because of its leverage, the leveraged aspect of it, then I'd rather just not invest in it. Because my whole thing with swing trades is that I got to be willing to hold it long term. And if it's going to decay over time, it's kind of the opposite of that. But I appreciate that update. Again, I try to be transparent, of course, and I have no idea what's going to happen. And that's one of those niches of trading where I'm just not super familiar with it. All right, guys. So, yeah, market just went slightly red for the first time today. SPY down at 404 is here. And my guess is this is people anticipating the Jerome Powell bearishness and jumping in here. And again, it's not a for sure thing that Jerome Powell is going to be bearish, but I think a lot of people are speculating that it might be because, again, what they're looking at is Jerome Powell's tone during the last time he talked, which I believe the last time we saw Jerome Powell was during the Economic Club of Washington, I think is what it was. And he said some optimistic things that caused positive price action.
as well as the Fed rate hike decision that was at the beginning of February. Now, at this point in time, though, things have changed a little bit, specifically with regards to CPI, PPI, and inflationary data and metrics. And with that, they've gotten worse. And so it's plausible and reasonable, I think, to assume that because those things changed since the last time he spoke, or we heard from Jerome Powell, essentially, that he might correct his tone to fit what we saw with the inflationary metrics that we saw over the last month. Again, that's, I'm sure, why people are a little bit more skeptical of this next Jerome Powell conference. And again, today he's going to be testifying before Congress. Tomorrow he's going to be testifying before the House. He does this twice a year. So he does this twice a year where he kind of updates people in the market. And again, today is going to be at 10 a.m. Market just bounced. So market's still technically green here. Meta finally pulling back to the 200 EMA. We'll see if it actually holds now. Hey, man, thanks for the stream. What can Powell say in front of Congress to tip the market? Well, he could say that inflation has gotten worse, that he's thinking about raising rates a little bit more aggressively than expected. Stuff like that is what he can say. And again, there's an inverse correlation between rate hikes and market activity short term, right? So if he basically comes out and says they're considering 50 basis points during the March 22nd meeting, which is coming up on March 22nd, right? If he says that, then again, it could be something where we see, weak responses in markets here. And I think that's a lot of what people are speculating on, is that expectation that he might come out a little bit hot in terms of their rate hikes. And that essentially is making it so that, people are nervous for that, if that makes sense, right? So again, Meta at 188s. We got Tesla bouncing up a little bit here. SPY bouncing back up. So SPY's green again. But again, let me know what you guys think. If we look at our poll numbers here, and we got 1,200 votes here, 57% are bearish, 43% are bullish. So yeah, all good. Crypto, no worries, man. Honestly, I hope that happens, Backroad. I'd rather him say positive things. TRK earnings. I'm in TRK right now, and it's spiking up a little bit. We're green on it, but I don't know what it's going to do. If you want to look at TRK earnings, TRKA is Troika Media, right? All right, so here is their EPS graph. So if you want to look at their EPS graph, so did they stop? Let me see what this is. So today is what's today, the 7th. Yeah, for whatever reason, we stopped getting data for TRKA, and or when is their next earnings report? Is it today? When is it? So quarter 2 unconfirmed from March 21st. Okay, so we still have until March 21st, right? So again, if we look at their earnings graph here, here's their EPS graph, right? So here is, what is this? Yeah, so here's EPA or EPS for TRKA. It's gone from 90-cent loss, 67-cent loss, 61-cent loss. Quarterly, they actually showed a slight profit in the last earnings report, which was in September. And so, their earnings are scheduled for a couple weeks from now. And we'll see what they do. Like I said, we don't really know if they're going to be good or bad. We'll see. Hey, what's up, Jessica? Come on, break the 200 EMA 4 hour. On which one, Nicholas? On the SPY? We have the 200 EMA. I like putting the 200 EMA and the volume weighted average price up there. So the 200 EMA is all the way down at 401.40s. We'll see if we hit that or not. I don't know. Meta bounced it up a little bit. There's Tesla with a random rogue order getting filled there, but TRKA is moving up. We're slightly green in it. Bitcoin at 22.3s. All right, market back red technically on the day. And again, if you want to know why, I look at 1 minute charts. I look at 1 minute charts because we can see when the red to green level breaks here. I think it's the only chart you can really lose. You could look at a 5 minute chart, but you're not going to see the same thing as easily. Like you're not going to see the same thing. And so a 1 minute chart to judge price action, I think makes sense. And again, the SPY is technically red. We are just underneath that previous closing price. We're at 404.45. So previous close is just under 404.50 on the SPY. TRKA is starting to pop though. If you look at TRKA, again, we did buy a little bit of shares here, but it's very small, relatively insignificant. Powell 75 basis points is possible. Did he actually say that, or are you just really, really short bias hoping the market drops because you're holding a bunch of short positions? 2 minute charts can be good, yeah. 3 more hikes, maybe, Mike. Again, I don't. What Powell said, if we look at what Powell actually said during the last thing, he said that he doesn't know if we're gonna hike, or he doesn't know if we're gonna pivot to no hikes this year, is what he said. So he basically said he doesn't know if we're gonna pivot to no rate hikes. So basically, like, he doesn't know if we're gonna just basically go to zero this year, is what he said. He said that during the last rate hike decision. Well, I never say never, Kenneth. It's not something where I never do anything. Like, sometimes I'll poke around at penny stocks, but I'm certainly not like taking any risky sides. I got 100 shares to put into perspective of TRKA, so a very, very small position that is, you know, if TRKA went to zero, I'd lose $100. So if we do get a big crazy squeeze, and again, I've done this a couple times throughout the years. What I'm saying is I never invest money in penny stocks is really probably what you heard me say. Like, I'll buy penny stocks short term, but I never invest in them. Even swing trades I usually don't do. I'll probably cut this today. But investing in them is incredibly risky and sketchy, you know. Hikes will affect economy 6 months or 1 year about mortgage rates or something, so it doesn't really matter. I can't eat Taco Bell, man. Taco Bell, like, my stomach doesn't agree with it. I love Mexican food. Mexican food's my favorite, but Taco Bell, not that good. Give me some birria tacos. TRKA started to move though. Look at it. So SPY back over the previous closing price. It's at 404.50s. All right, guys, TRKA up to 95. Y'all hear this? What is that? Birds out there fighting. We've got a gang fight of birds out behind my window. I don't know what that is. Anyways, TRK pull it back a little bit. SPY still confirming red, breaking down here. We'll see if it continues. Yeah, I'm pretty flat. I mean, I'm not really holding anything like super significant today. And Tesla is right here on the right. It's at 190, 170s. Oh, the birds, they want to see Tesla price. Hey, all good. All right, guys, we have 40 minutes, guys. 40 minutes. I'm also going to put it in sub-only mode. So if you have not already, hit the subscribe button, guys. You know you want to. Just do it one time. See how it feels. It might feel good. Try it out. Do it now. Guys, market starting about SPY back technically green, but chopping back and forth right at the neutral level here. Again, if you don't see this, here's the previous closing price. Here's the previous close, right? So you can kind of see the SPY is just kind of chopping back and forth between it. Short on Taco Bell confirmed A. Do you think Jerome will confirm rate hike just to keep the heat from Congress off, or try to promise the increase to scare the market and people? I think you're looking at it wrong. I think he has a fiduciary duty to be honest and objective. And I know people, I know if he does something that people are going to be negatively impacted by, they say he has all these ulterior motives. I think it's a very difficult job to be the Fed chairman. He doesn't make a lot of money doing so as well. He makes $200,000 a year, you know. Like this year we'll make that close to that running this YouTube channel, to put it in perspective. And so, you know, he doesn't get paid a lot relative to the heat he gets on a daily basis. And I don't know if I would take that job. I'd probably take it in a heartbeat, to be honest. John, beginner trading, Fed chairman. How would you feel if I started, if I held a press conference and I started doing these? Anyways, I digress. But my point is, it's a very difficult job. And I think he gets a lot of heat when the market's up. Nobody gives him credit. When the market's down, everybody blames him. It's an incredibly difficult job. And yeah, it's one of those things where I think he has a fiduciary duty to be honest with people. And, you know, so I think he tries his best to be honest. I don't think he wants a crash under his watch as well. So, but I also, like I said, I don't think he wants a crash under his watch. But I think the whole point of the Fed raising rates is to discourage spending and cause some short-term pain in markets. And so I think he'll be honest about it. And I think he's been pretty objective so far this year. Top 3 best chairman in the world, for sure. Definitely top 3. Yeah, I mean, we'll make roughly, I mean, I don't know. I'm not going to be too specific, you know, and just general business income, you know, we do well. But point is, he doesn't get paid a lot to be Fed chairman, you know, relative to what that job entails. That's a tough job. He doesn't get paid a lot for it. I'll put it that way. Yeah, definitely top 2, Raul. You know. Show me your paycheck. I quit my job and work for you, bro. I don't need, bro, to be honest, I got a lot of people that want to work for me, and I have to turn a lot of people down. Like, I get a lot of people that want to work for me. Like, in the end, we're just a small YouTube channel. You know, I mean, we're not that small, but like, we don't need a bunch of employees. It's just not worth it. Like, the amount of the net gain that we get from hiring people is not going to be worth the money spent on it a lot of the time. And if anything, like, I've probably been a little bit too loose with, you know, mods and all that stuff. Like, I've probably taken on too many mods. We don't even need that many mods. It's just not worth it. And I think, you know, over time, I realized that, like, it's just easier to keep it with just me, and like Pawn's probably my main mod. Douglas helps out a lot too, but that's all you really need. We just don't need more than that. Hey, my guy MS, I don't know how much that is. I think that's a big donation, man. Hey, my guy, shorting Bitcoin today. Hey, good luck, brother. I appreciate that, man. That's a lot, I think, right? That's a big donation. Let me see. That's in Australian dollars, right? That is $66. Hey, thank you so much, man. 67 if you round up. Thank you so much, man. I appreciate you, brother. Thank you, man. Good luck. Hey, good luck today to you, sir. Thank you so much, man. I appreciate the donation, brother. Thank you. Yeah, I mean, good luck, man. I hope you make some money, brother. Again, I could see how you might. Of course, I have no idea what we're going to get. No idea what the market's going to give us today. No idea. But I understand the logic of that trade. So yeah, thank you so much, man. I really do appreciate it. And I understand the logic. I really do. The logic is essentially, again, Jerome Powell spoke last. He was pretty optimistic. I think the market went up from the Jerome Powell speech that we got last time. But things have kind of changed relative to when he spoke last time. We've had higher inflationary numbers. Inflation has gotten worse. CPI was worse. PPI was worse. A lot of stuff were worse than before. And so in that regard, it's plausible to assume that we could pull back a little bit today. Again, I'm not saying we will. I have no idea. I have no idea what I'm talking about. I might be wildly wrong about everything, and I'm sure at least 30% of you or more would agree with that. But thank you so much for the donation, man. Good luck. I could see it could work out for you. Good luck. If I was going to take size in crypto, what I would probably do, like you can get some big leverage in crypto. What I would probably do is take some decent positions, but be willing to lose everything, you know, on these big polarized releases and days where somebody's speaking. Maybe it's Jerome Powell, maybe it's the Fed rate hike decision, maybe it's CPI. You know, as long as you're okay with losing, you know, I mean, hey. What do you think Powell will say today? I don't know. I really don't know. But yeah, thank you so much, man. I genuinely appreciate it. That's an amazing donation, man. Thank you so much. But yeah, I really don't know what he's going to say today. Again, I could understand how the short bias mindset ahead of this meeting might be the right move. Again, I'm not saying it is. I have no idea. But I think it's reasonable to assume that we could pull back some because of Jerome Powell's change in tone, because the metrics that we got over the last 30 days were different and worse, objectively worse than the metrics we got over the prior month, if that makes sense, right? So CPI came in higher than expected. PPI came in higher than expected. The inflationary metrics that we got this month were worse than the previous month before, that were basically the metrics that we've gotten since the last time he spoke have been worse. And so it's an understandable assumption that he might be a little bit more hawkish in tone. And if that happens, market might drop. We'll see what happens. Market is completely neutral right now, completely sideways, though. So we are literally right at the previous closing price. So basically flat neutral today. And we'll see what happens. Hey, thank you so much, MS. I genuinely appreciate that, man. Thank you so much. Yeah, earnings are the 21st, Lucas, right? So the 21st. Any other news anytime soon before FOMC? Yeah, we got a whole bunch of news stuff coming out, Kelvin, over the next 3 weeks here. Just to put it in perspective, just this week alone. All right, so just this week alone, I'll give you a full breakdown. Today, we got Jerome Powell speaking in front of Congress. Tomorrow, we have him speaking in front of the House. Before he speaks tomorrow, guys, we're going to have, non-farm numbers coming out. So non-farm numbers are going to come out tomorrow at 8:15, as well as some other economic data. So non-farm numbers, which do move markets a little bit, not a ton, but they move markets some. And then Jerome Powell speaking again tomorrow, as well as him obviously speaking today. And then Thursday, we've got jobless claims. Friday, we have unemployment for both the U.S. and Canada dropping. So unemployment, obviously a big release for the U.S. and Canada Friday. As well as we have non-farm payroll numbers, which are another big economic release Friday. All right, so that's just this week. We've got like 4 or 5 relatively decent economic influences this week. And then next week, we got some stuff. There's the market open, guys. I know I'm a little bit slow. There's the market open. But yeah, we got a lot of stuff happening so far. So yeah, there's the opening bell, team. We will try to day trade here. Let me get my futures trading out before we trade. And I'm a little bit slow on this, so my apologies, guys. Big dips at the opening bell. The big dips at the opening bell. And again, let's see if we hold this breakdown or see what happens here on this breakdown. All right, TRKA testing highs of the day here. We'll see if it continues. But here is the E-mini. TRKA up to 97s. 98s. Hey, props to Martin. Martin was right here. SPY started to move back up. Let's see if we buy the dip. And we made money, I think, every day. Let me see. Yeah, it's been a pretty good month. Let me see. Did we make money yesterday? We traded yesterday. Hold on. Let me reopen this up. All right, market just broke down. Okay, yeah, we made money yesterday. Not a ton, but we still made money. I'm gonna short. The reason I'm shorting is, well, I'm shorting because we rejected pretty quickly there. But we will cut it. Luckily, it's just one contract. Add a little bit more to it. 2 contracts now. See if we get the flush breakdown. That's a big rejection there. That looks pretty weak. And again, we will stream the full Jerome Powell press conference in about 27 minutes. You can see the timer on the top right. Or the left, top left, I mean. All right, 3 contracts here. Quick flush rejection back down again. Problem is Tesla's rebounding pretty quickly. I might cut this fast, but we got a little risk level at the top of that candlestick. Pretty flat on the day now. The problem, though, is Tesla right now looks very strong. And so I think I'm going to cut this. I think there's too much risk. And yeah, it looks like that was the right move. Tesla looks very strong. Hey, my guy, Dan. Again, Tesla's starting to rip up. I might buy this dip now. So we might pivot to the upside here. Just with the assumption that Tesla's going to drag the market up enough. TRKA just dumped at 99. Okay, we're slightly green here with our 2 contracts. Hold it for a longer time frame, kind of reversal trade maybe, but Tesla pulling back, but it looks like a cup and handle breakout pattern. Flat right now on the 2 contracts. I could add some more. And if we get a retracement, we might. There we go. I don't mind that. There's 3. We'll get into maybe 4 here. Looks like a reversal pattern. All right. I like the retracement candle. That's usually a strong sign. We just broke highs and then rejected very quickly. Yeah, it's time to cut it. All right, so we've gotten chopped out at neutral from neutral price action a couple times already. We're probably going to start to slow it down. We're down like 30 or 40 bucks, so pretty small. But with the Jerome Powell press conference looming here, it might not be one of the days that swinging big's the right move. We don't really have any big obvious price action. Apple actually started to look red to green, and Tesla still looks okay. just scalped a little $10 bill from actual stocks just now, buying Tesla and then riding the bounce back here. Bitcoin's starting to rise too. In the previous close and then pulling back a little bit. Yeah, we slowed down trading the chop. We just rejected at the previous closing price. Apple was back up there, but Tesla just broke under the VWAP here. So Amazon go to the moon. Amazon at 94.60s. Amazon looks very strong. Yeah, I'm going to buy this just because Apple's starting to break over the previous closing price and really drag up here. But again, it's pretty small size overall. A lot of down wicks and up wicks. It doesn't look the best, to be honest. Looks difficult. Apple up to 95s. NQ is going long. Yeah, the NASDAQ 100 is essentially going to do a similar thing to this one. Tesla over highs of the day now. Apple's still pumping up. TRK earnings are out now, Lucas? Are they really? I thought they were coming out on the 21st. A lot of consolidation at this point in time on the day here. And again, Jerome Powell speaks in about 20 minutes, team. 20 minutes. So I'm sure that'll influence everything. Apple just broke over highs of the day again. Took half off there, just locked in a little bit, but gonna let me be a little bit looser on the rest. Amazon broke highs of the day as well. So Apple broke highs, Amazon broke highs. Apple over the previous closing price. Amazon almost in 95s right now. So I'll go ahead and cut that. So just made a little bit there. Pretty flat on the day. Yeah, we're gonna stream the full Jerome Powell press conference today for sure. Subscribe if you haven't yet. We cover all the big economic data here. The market likes to go up when Powell speaks generally. Not necessarily, I think. Again, Amazon all the way at 95s. Big dip. Apple pulled all the way back under previous close, under VWAP. I might short this. That looks like a very weak sign for Apple. It is at the volume weighted average price though. But TRKA is still pretty flat. Amazon's still at $95 even. All right, so we're in two contracts here. Big up wick. A lot of choppy wicks though today. And we take small size on days like this so that we're not risking a ton, to be honest. Tesla just broke under the VWAP. Let's take another 3 contracts. See if we can bet on a reversal happening here. There we go. Apple pulling back. Tesla finally pulling back too. All right, guys, we got 18 minutes here, team. 18 minutes. There's the flush starting to happen. Such a choppy open, though, team. Very choppy morning. There we go. Lock in a little bit. Let the full breakdown happen with most of the position, but basically a neutral day right now. I might cut this now. I see Tesla starting to actually rebound back up, but we're gonna wait and see if we crack this low real quick. There we go. I just took half off there on the crackdown. Basically break even on the day now. Starting to dump. All right, we'll cut that. All right, market's starting to break down. So our reversal was right. And again, we got ourselves back to break even on the day. But with 15 minutes left, guys, the gov decided to refine definition of, yeah, that's what I was saying. People saying, hey, we have to have a recession. It's like, well, technically we did already. If we go by the definition of it, which is 2 consecutive GDP quarters. You know, and again, we already got that. And so now, do we break down more? Maybe, but I don't think the argument of, hey, we need to have a recession before we can bounce back is there, because technically we already had one. All right, guys, 15 minutes, guys, 15 minutes. We got about 1,000 people here. Yeah, but Stelios, you don't think we've already had one? I guess is the real question. I don't know, Kieran. Please don't spam. You'll get banned very quickly. All right, very choppy market open. First 15 minutes are here, and we're basically sideways. Hey, what's up? Greetings from Poland and Germany. Hey, what's up, man? Hopefully y'all are doing well over there. Market's starting to break lows. So we were spot on with our reversal call there. We didn't hold on to it a ton, but we're pretty right with it. Well, the technical definition, though, Carol, of a recession is, again, if you look at what most experts consider a recession, it's 2 negative GDP quarters. And again, we already had that. Now, we could throw some other definitions in there, but again, the definition that I'll put it this way, the definition that they're using to judge rebounds are the technical definition with 2 consecutive GDP quarters, right? Like, that's the definition they're using to say, hey, we still need to drop way more, because we haven't had a recession, right? But, and X amount of, markets over the last however long, needed a recession first, right? But the definition they're using for that is what we've already experienced. You know what I mean? And so now there might be other nuance to it. And again, I might be wrong here, but to a certain extent, technically, we've already had it. Today, right here, Simon. We're gonna do the Powell meeting. Snap. What's Meta doing? Snap flying up. Meta breaking down. SPY very choppy and neutral, not unexpected. All right, market's trying to bounce back. Apple break it down a little bit here, but a very sideways market. With that said, though, guys, we are going to get ready. Yeah, we're going to stream the report right here. Market is very sideways, guys. Again, just be very careful. Like the market is incredibly choppy right now, to be honest. So just be careful. Market popping back up. Again, so far, this is the range of the market today. Again, we're all kind of sitting back, waiting patiently for this. But here's the range. Sideways, neutral, not unexpected. Again, we got Jerome Powell testifying today, so it's not unexpected that we're neutral ahead of this. We got about 10 minutes. All right, tap the top of that range. Broke the top of it, so again, we'll see if we continue on that ramp up. Maybe, Carlos. Maybe, brother. We'll see, man. All right, guys. Micro E-mini starting to test the top of the range, but Apple pulling back, Tesla testing lows again, so might pull the market back down. So the market was technically green for a second. We're pulling back to the volume weighted average price now. So again, we got 10 minutes. All right, market's still at the top of that range. Hasn't really done much. Again, a lot of people are probably waiting to see what we get here. That's my guess is a lot of people are waiting to see what he says. Spot dipping down, choppy action, Apple bouncing back up. But again, we got a very choppy neutral market right now. Not a lot of big edge in this, in my opinion. All right, guys, 8 minutes. Yeah, so this is the semi-annual monetary policy report to the Congress. We are going to stream the whole thing live right here. We're just waiting for it to start. It hasn't started yet. We are waiting live for this to start. Bull or bear, let me know. Hey, all good. Again, we're going to stream this thing live. It starts in 6 minutes. Gold is a safe haven asset. I mean, I think gold is good for just that, being a safe haven asset. If you think the market's going to crash, gold is probably the right thing to buy. But again, a crash isn't certain. Market is really, just to put this into perspective, guys, here is the previous closing price. The previous closing price is right here. So we will make this a red line so you can see the red to green level. We'll make it a little bit thicker here as well. That red line is the previous closing price. It's the level at which the market goes from red to green, green to red on the day. Looking at our poll numbers here, we got polls all the way around here. We got one on YouTube. We got about 2,000 votes. 56% are bearish, 44% are bullish. But you can kind of see in choppy, neutral, apprehensive market days, you know, it stays roughly around that previous closing price. So you can kind of see we're essentially just doing this. We're going up and down and up and down. We're kind of hugging this previous closing price level right there. So basically neutral activity. And again, Jerome Powell, Big Papa, is going to be speaking in about 6 minutes here. And so we'll see what he says. "25 basis points. The market drops 1%. Michael Burry will say, I told you so. Bro, if the market drops 0.25%, Michael Burry will be like, see, I told you. You know, my guy's track record has just not been that great, you know. I mean, he predicted like I said, I actually like Michael Burry, believe it or not, guys. I really do. I do really genuinely like Michael Burry. And so, you know, he seems like a good dude, smart guy. A little bit too short biased for my taste, but regardless, seems like a smart guy. You know, I love the Big Short movie. Big Short's one of my favorite movies. Big Short movie is actually why I got into the stock market. So I saw the movie in theaters with my wife, Carol. And at the time I saw it, I had no idea what a short even really was, to be completely honest. And I went and I saw that movie, and I've always been like a poker player, like a strategy player. Market just broke under that previous closing price right here. I've always been kind of like a strategy, like chess, poker, you know, checkers, whatever strategy game is. I've always loved strategy games. And so I saw that movie, And I realized how much money was floating around the stock market. And so that's when I created my channel, Beginner Trading. And, you know, the rest is history here. But again, I love The Big Short movie. But I think when you look at Michael Burry's history here, you know, Michael Burry telling everybody to sell ahead of the last Fed rate hike decision, and then we ripped up from it. And then when GDP came out, he thought we would drop more. So after the Fed rate hike decision, after he was wrong about the Fed decision, he deactivated his Twitter account. And then GDP came out, and he thought that would cause the crash too. And so we had a little bit like 25 or like 0.25% drop in the market, and he reactivated his Twitter, and then we rebounded basically back up since then. And again, maybe he's right, and maybe it just takes a long time to really show that he's right. I know in 2007 and 2008, a lot of people were doing the same thing where they essentially said he was wrong, and time showed that he was right. And that would be one thing if he only called a short position like recently, but he's been basically yelling market crash for the last 10 years. And so I don't know, market started dip again, very choppy neutral market. Here's essentially the sideways market that we're in. All right guys, 2.5 minutes. All right, so yeah, we are in there. They've started the video. Hearing as we are here waiting. We are live right here waiting. 2 minutes, guys, 2 minutes. I'm trying to put this up where you can actually see the market too. Yeah, we'll put this up right here. As long as everybody doesn't cry, because I'm using a 1 minute chart. I'm using a 1 minute chart to show short-term like volatility and momentum here, just to put it into perspective, guys. How does that look? Does that look good? Yeah. And when we stream, I'll probably like minimize my head here. Here, let me y'all can hear the music right now, correct? Y'all can hear the music right now, correct? You should be able to. I'm here to watch your head. Hey, I have 4 monitors. Yeah, so we got 4 monitors. I might pull up this one. This one's a little bit better, I think, right? I might pull it up like this. I think this one's actually a little bit better. All right. Market is dumping down here, dumping down here. Do we have some economic data dropping today? I don't think so. Oh, we got the JOLTS job report. It came in at 10.5 million versus 11 million expected. 10.5 million for the JOLTS job report versus or no, that's tomorrow. Maybe I'm wrong here. Okay, here it is. Wholesale inventories came in at minus 0.4% versus 1% expected. Yeah, we'll put these numbers up. Wholesale inventories came in at minus 0.4% versus minus 0.4% expected. Wholesale sales came in at 1% versus 0.1% expected. I guess that's causing inflation fears. And look at the huge drop that we got from that here. Wow. Again, they're still not live yet. Hey, thank you so much for the donation. Hold on, guys. Market's dropping. Bear with me. It's supposed to start. It says we're live. Yeah, it says it hasn't started yet. Let me check their YouTube channel. Market is dumping down here. Yeah, so they haven't started it on their end as well. Jerome Powell did say here that so I'm showing here that Jerome Powell says that if incoming data indexes faster tightening is required, Fed is prepared to increase the pace of rate hikes. Says the ultimate level of interest rates is likely to be higher than anticipated. That is what just dropped right at 9 o'clock here. This is what the market is dropping down from. Oh wait, wrong one. Yeah, so this is why the market is dipping. That is why the market just reacted like that, is because they put that out. It's not live as well, guys. Like, look, if you, again, people could say it's covered in other places, but like, look, here's their YouTube channel. Okay, here we go.
Paychecks. Prices are still too high across many parts of the economy. We know that who feels it the most when the cost of rent and groceries go up? It's not the economic pundits and politicians who lecture us about discipline and stability. It's not the corporate executives who pretend they're making tough choices about prices while reporting record profit increases quarter after quarter and doing more and more stock buybacks. It's the people working hourly jobs to make ends meet. It's seniors on fixed income and Social Security. It's everyone who gets their income from a paycheck each month, not an investment portfolio. It's those same Americans who stand to lose the most if the Fed's actions to curb inflation go too far. No matter what goes wrong in our economy, a global pandemic, a war in Eastern Europe, weather disasters, profits somehow always manage to go up. Workers are left paying the price. As you've noted, Jerome Powell, the Fed's tools are only one element in our fight against inflation. It's a complex problem. Interest rates are a single, we know, blunt tool. Raising interest rates can't rebuild our supply chains and fix demand imbalances from the pandemic. Raising interest rates won't end Russia's brutal invasion of Ukraine. Raising interest rates won't prevent avian flu from devastating 1/3 of our egg supply, or weather disasters from destroying key crops. And raising interest rates certainly won't stop big corporations from exploiting all of these crises to jack up prices far beyond the increase in their costs. Last year, corporate profits hit a record high. Corporate PR chiefs assure us that these companies plans just have to raise prices. Corporations. Their costs are going up. The workers just want to be paid too much. It's so brazen. They have no other choice. Called in the Fed.
I'm sorry,
to
guys.
identify
We got
this
too many monitors
is one of the biggest drivers of inflation. Paul Donovan, chief economist of Global Wealth Management. It's so brazen. Even global bankers called in the Fed to identify this profiteering is one of the biggest drivers of inflation. Paul Donovan, chief economist of Global Wealth Management at UBS, wrote, "The Fed should make clear that raising profit margins are spurring inflation.
All right, we're live.
Companies have passed higher costs on to consumers, but they've also taken advantage of circumstances to expand profit margins. The broadening of inflation beyond commodity prices is more profit margin expansion than wage cost pressures." Think about that. From a chief economist at UBS, I'll say it again, they've taken advantage. These companies have taken advantage of circumstances to expand profit margins. The broadening of inflation beyond commodity prices is more profit margin expansion than wage cost pressures, unquote. The Fed, understandably, the Fed can't force corporations to change their ways or rewrite the Wall Street business model on its own, but the Fed can talk about it. High interest rates, falling wages, increasing unemployment are all hallmarks of failed policies that end up helping Wall Street, the largest corporations in the country, the wealthiest people in the country. Because let's be clear what we're talking about when people use the economic speak that can cloud this conversation. Cooling the economy means laying off workers. Lowering demand means workers get fewer raises. Of course, there are times when the Fed must act. We can't allow inflation to become entrenched. We've seen encouraging trends that isn't happening. And there are other ways we can bring prices down instead of lowering demand. Again, making people poor, laying people off, denying worker raises. We can speed up and strengthen our supply chains. We can bring critical manufacturing back to the U.S. We can rebuild our infrastructure. It's what we're doing with the CHIPS Act, with the Inflation Reduction Act, with the bipartisan infrastructure bill. For the first time in decades, we're finally recognizing the damage that I and many of my colleagues warned the corporate offshoring would do to our economy. Look at East Palestine, Ohio, a community that Senator Vance and I have visited a number of times recently. America learned about this small town last month when a Norfolk Southern train derailed and spewed hazardous material into this community. East Palestine is more than just a disaster headline. Columbiana County was once the center of American ceramics manufacturing, at one time producing 80% of ceramics of dishware in this country. One county produced 80% of it. When I was there last week, I was talking to the sheriff at the 1820 Candle Company. He was talking about how the last one closed just a few years back. Like so many industries, these jobs moved overseas, and we know why. The same reason Norfolk Southern cuts cost at the expense of safety, eliminating one third of its workforce in the last 10 years. Then you're surprised with these derailments? It's the same reason corporations now keep prices high, even as supply chains stabilize. It's the Wall Street business model. Chair Powell knows that. I know that. My Republican colleagues and Democratic colleagues know that. It's a Wall Street business model. Quarter after quarter, corporations are expected to cut costs at any cost. They skimp on safety. They move production overseas to countries where they can pay workers less because of trade deals that they lobbied for. And Wall Street demands they post profit increases, even in the middle of a global pandemic. That's the problem with our economy. And not only will higher interest rates not solve it, if they're overdone, they'll make it worse. We can't risk undermining one of the successes of our current economy. For the first time in decades, workers are finally starting to get a little power in this economy. Unemployment's at a historic low, 3.4%. That's not just a number. That means Americans have more opportunities, more options, even in places that haven't seen a lot in recent years. It means people have the power to demand raises and retirement security and paid sick days and some control over their schedules. It means more Americans have the dignity that comes with a good job that provides for your family. We must here ensure that all Americans have the opportunity for that dignity of work. It's a critical time. The consequences of missteps could be severe. Mr. Chairman, two more things that affect your job. It's not just monetary policy that threatens American pocketbooks. Some of my colleagues have threatened the nation's full faith and credit by holding the debt ceiling hostage for partisan politics. Instead of paying our bills on time, they're essentially threatening all Americans. The Fifth Circuit's Consumer Financial Protection Bureau ruling could also cause unimaginable instability and chaos for families, for consumers, but also, as the chair knows, for a financial system. The Fifth Circuit is Wall Street's, no doubt about it, the Fifth Circuit is Wall Street's favorite courthouse. It recently ruled the CFPB's independent funding is unconstitutional. If the Supreme Court upholds the Fifth Circuit's ruling, it will not only devastate CFPB, it will threaten the independent funding of many other federal agencies, including the Federal Reserve. I look forward to today's hearing, how the Fed will balance its dual mandate and continue to promote an economy where everyone who wants a good job can find one, an economy that works for everyone. Senator Scott. Sorry.
Good morning, Jerome Powell. Sitting here, looking at my prepared remarks, thinking about, there's an opening coming where Vice Chairman Brainer's moving on. I think it's really important for us to make sure that all the information that we need in order to make a good decision on the next nom that we have in a timely fashion. So I would really implore the chair to make sure that happens, that every questionnaire that is asked from the person, we get. Every member of this committee has their questions answered in a timely fashion. and that the staff has their answers in a timely fashion. Listening to Chairman Brown, I thought to myself, fascinating, truly fascinating. I concluded that, well, I know Chairman Brown pretty well. I am sure he is sincere in his rant. But let me just say this. Spending and printing trillions of dollars, caving to the radical left in this country, seeing policies posited and then implemented that led to the worst inflation in 40 years, seeing our inflation at 9.1%, seeing American families struggle because of the weight of the government on their shoulders, seeing the devastation from South Carolina to Ohio. It's unbelievable that the progressives in this country who caused a 9.1% inflation would then turn somewhere besides in the mirror to see the absolute devastation caused by their out-of-control spending is remarkable. Remarkable. To stop the out-of-control inflation caused by the out-of-control spending, the Fed steps in to cool the economy. Well, the definition of cooling the economy is necessary because we've seen the most radical approach to a problem that was in our rearview mirror being used as a Trojan horse to bring in a level of socialism and spending that our nation has not seen in my lifetime. The facts are very simple. When you get to 9.1% inflation in this nation, as a kid who grew up in a single-parent household, mired in poverty, a 40% today, 100% just a year ago increase in the gas prices devastates single mothers around this country. For seniors on fixed income whose savings are being depleted with an average cost just last month of a $433 increase because of inflation. For my friends on the other side of the aisle to look any place besides a mirror, I find stunning. The truth is that when your food prices go up over 20%, when your electricity is up over 20%, you have to ask yourself, where in the world are they? They cannot be in this universe. It must be an alternate universe where, in fact, it's okay for us to see prices go through the roof and our economy not stumble, but fall into a ditch. Why are we in the ditch? Because progressives used the pandemic as a way to usher in a form of spending that takes the money out of the pockets of everyday Americans and puts it in the coffers of the government. There is a better way. The better way is to trust the American people. And when you do so, we don't have to have the Fed come in and raise interest rates so high to quell the challenges in our economy so that today versus 18 months ago, the price of the same house for your mortgage payment is twice as high. Why? Because of the runaway spending of our friends on the other side of the aisle. I'm sure I do not have time for my opening comments, but I will say without any question, as I look around the country and I ask myself, how devastating is it that today it costs $433 more than it did a year ago? The answer is it is a crisis. When the average family in our country just a couple of years ago didn't have $400 in their savings for an emergency, to have prices go up by this amount, it's devastating. To have a conversation about rents around the country, looking at the inflationary effect and the absolute devastation of a snarling supply chain that we haven't seen in my lifetime, run by my friends in the progressives. Unbelievable. But to get to you, Chairman Powell, one of the comments that you've made that I think is really important in one of the speeches you gave in January, and I apologize for my rant. I just wanted to make sure my rant was consistent with my friend here. It is essential, you said, that we stick to our statutory goals and authorities, and that we resist the temptation to broaden our scope to address other important social issues of the day. Taking on new goals, however worthy, without a clear statutory mandate would undermine the case of our independence. You further noted that, and I quote, without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools to promote a greener economy or to achieve other climate-based goals. We are not and will not be a climate policy maker. Do you still stand by those comments?
I do.
Thank you. Finally, I know we're not in the question. I know, I get it. Finally,
You now have 4 minutes and 12 seconds.
yes, I knew the chairman would dock that from my time, and I appreciate you doing so
With a sense of humor.
with a great humor. Great humor. Finally, several of my Republican colleagues and I sent a letter to you discussing Vice Chair of Supervision Michael Barr's plan to conduct a holistic review of capital standards. I look forward to discussing those capital standards during my Q&A, and I will thank you for our recent conversation that we had that helped illuminate some of the necessary challenges that we face as a nation and your answers to it. Thank you, Mr. Chairman.
Thank you. Speaking of illuminating, thank you, Senator Scott.
Yes, sir. Thank you for allowing me to use this.
Today we'll hear from Chair of the Federal Reserve, Jerome Powell, on monetary policy in the state of our economy. And I don't expect Chair Powell to weigh in on the mini debate we just had, but I think we all know that the debt increase was much larger under President Trump and a Republican Senate than it has been since. Chair Powell, thank you for your service and your testimony today.
Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do. Our policy actions are guided by our dual mandate to promote maximum employment and stable prices. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. I'll review the current economic situation before turning to monetary policy. The data from January on employment, consumer spending, manufacturing production, and inflation have partly reversed the softening trends that we'd seen in the data just a month ago. Some of this reversal likely reflects the unseasonably warm weather in January in much of the country. Still, the breadth of the reversal, along with revisions to the previous quarter, suggests that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. From a broader perspective, inflation has moderated somewhat since the middle of last year, but remains well above the FOMC's longer run objective of 2%. The 12-month change in total PCE inflation has slowed from its peak of 7% in June to 5.4% in January, as energy prices have declined and supply chain bottlenecks have eased. Over the past 12 months, core PCE inflation, which excludes the volatile food and energy prices, was 4.7%. As supply chain bottlenecks have eased and tighter policy has restrained demand, inflation in the core goods sector has fallen. And while housing services inflation remains too high, the flattening out in rents evident in recently signed leases points to a deceleration in this component of inflation over the year ahead. That said, there's little sign of disinflation thus far in the category of core services excluding housing, a category that accounts for more than half of core consumer expenditures. To restore price stability, we'll need to see lower inflation in this sector, and there will very likely be some softening in the labor market conditions. Although nominal wage gains have slowed somewhat in recent months, they remain above what is consistent with 2% inflation and current trends in productivity. Strong wage growth is good for workers, but only if it's not eroded by inflation. Turning to growth, the U.S. economy has slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Although consumer spending appears to be expanding at a solid pace this quarter, other recent indicators point to subdued growth of spending and production. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight. The unemployment rate was 3.4% in January, its lowest level since 1969. Job gains remained very strong in January, while the supply of labor has continued to lag. As of the end of December, there were 1.9 job openings for each unemployed individual, close to the all-time peak recorded last March, while unemployment insurance claims have remained near historical lows. Turning to monetary policy. With inflation well above our longer-run goal of 2%, and with the labor market remaining extremely tight, the FOMC has continued to tighten the stance of monetary policy, raising interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee slowed the pace of interest rate increases over its past 2 meetings. We will continue to make our decisions meeting by meeting, taking into account the totality of the incoming data and their implications for the outlook for economic activity and inflation. Although inflation has been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Federal Reserve, we will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you, Mr. Chair. There are 23 of us on this committee. Almost everyone will be here today. I ask each of us to stay as close to the 5-minute mark as we can because we have votes at 11:30. So thank you all for your cooperation. Chair Powell, thank you. Job growth is strong as unemployment remains historically low. You might not know that from the opening statements. Many drivers of inflation, corporate greed, rising inequality, supply chain disruptions, Russia's bestiality, if you will, in Ukraine, won't get better because of interest rate increases. Every indication is that this post-pandemic economy is different. Should we be worried, Mr. Chair, that the Fed is treating this economic period as it has in the past instead of reacting differently?
Thank you, Mr. Chairman. So we've been aware since the very beginning and have said have discussed this publicly on many occasions, that there are some differences this time. We, in particular, have not seen the kind of supply side collapse that we saw at the very beginning of the inflation outbreak. Also, the outbreak of a war, which had significant effects on commodity prices a year ago. So all that is different. There are also, though, some similarities. There is a mismatch between supply and demand. You can see that in the goods sector still. You saw it in housing prices going up over 40% since before the pandemic, and you see it in the labor market where we have 1.9 job openings for every opening, for every unemployed person. So we're well aware that this particular situation involves a mix of cycles of forces, not all of which our tools can affect. But there is a job here for us to do in better aligning demand with supply.
Okay, understanding you have limited tools to address inflation, and our conversations in the past show my concern about continued rate increases that may not actually address the root cause of inflation. They hurt workers, and many of us contend we can't follow the same old playbook. Next question. Last year, 3 banking regulators issued proposed updates on the Community Reinvestment Act to account for changes in our banking system. My question is, does the Fed remain committed to work with FDIC and OCC to finalize a CRA rule, and when will that rule likely be finalized?
Yes, we do remain committed, and I believe we are in broad agreement with the other 2 agencies on the revisions to the rule. So now we're in the process of writing all that down, and that'll take some time. And then after that, of course, it will come to the Board of Governors for a vote, and that'll involve briefings and discussions. And I can't give you an exact date, but
as quickly as possible.
Yes, but it will be some months.
Okay, thank you. Banks weathered the shock of the COVID-19 shutdowns mostly because of the fiscal response provided by Congress. We now see a spike in loan delinquencies, an increase in overall risk. Banks are again plowing billions, as many other corporate leaders, always defended by people on that side of the aisle, into stock buybacks, which makes me concerned that if there's a downturn in the economy, banks could end up with too little capital. That's why I'm worried about any potential rollbacks of safeguards or regulations. Can you assure me that the Fed will keep capital requirements strong and exercise more long-term forward thinking than corporate CEOs that seem to be focused on the short term?
I can assure you as to the first part that we'll keep capital requirements strong.
I didn't expect you to comment on give me an opinion about you're looking more forward than companies that look at the short-term benefits of stock buybacks. Mr. Chair, when you last testified, I asked you about the risk posed by crypto assets, stablecoin, the Fed, and other regulated possibilities. How's the Fed evaluating the risks of crypto-related activities by your supervised institutions?
So this is something we've been quite active in this area, and I'll say that we believe that innovation is very important over time to the economy. We don't want to stifle innovation. We don't want regulation to stifle innovation in a way that just favors incumbents and that kind of thing. But like everyone else, we're watching what's been happening in the crypto space, and what we see is quite a lot of turmoil. We see fraud. We see a lack of transparency. We see run risk. Lots and lots of things like that. And so what we've been doing is making sure that the regulated financial institutions that we supervise and regulate are careful, are taking great care in the ways that they engage with the whole crypto space, and that they give us prior notice. And we've issued, along with the FDIC and the OCC, a number of issuances of notices to that effect.
Thank you. And I will close with this. I've long pushed for the Fed to prioritize workers and for the leaders of the Fed to reflect the diversity of our country. We've made progress, but our work is not done. We have a new opening. Understand it's not your job to appoint the new Fed member. We have a number of upcoming vacancies at the reserve banks. I support Senator Reid from Rhode Island, Senator Menendez from New Jersey, and other colleagues who are pushing for more diverse voices at the Fed. Senator Scott.
Thank you, Chairman. Obviously, the chairman and I both have strong passions about the challenges that we face as a country. The one thing that I do believe that we agree on is the importance of having a strong capital markets as it relates to making sure that Americans have the ability to continue to grow their businesses and to solve their challenges. And frankly, I hope that we get there. building on the same comment that Chairman had around capital standards is where I'm going to go with my thoughts today. When I think back on these last few years, it's hard not to recognize the extraordinary efforts our financial institutions of all sizes, frankly, undertook to administer a program like the PPP, all while weathering a shutdown of our global economy. I welcome your thoughts, but from my viewpoint, our banking system was resilient. Our financial institutions stepped up and delivered aid to support families and businesses every single day. That's why Vice Chair Barr's broad comments around holistic review of our capital trouble me so much. We should be laser focused on our economy and addressing the needs of everyday Americans trying to forge a new future and helping them open the door to opportunity. As you and I both know, capital and its quality must be continually scrutinized, but increased capital does not necessarily provide an increased benefit, and requiring banks to hold capital that is not risk-based and appropriately tailored to a bank's size, scope, and activities can cause more harm than good. At a time of record inflation, where everyday needs are more expensive, we should not be pursuing actions that are harmful. Rather, we should be supporting the we must promote and further the growth of our economy and thereby our people. Anything less should be unacceptable. To that end, will you commit that any ongoing capital review by the Federal Reserve will follow the law and that any follow-on regulatory proposals
say that anything we do will reflect tailoring, which is a long-held principle for us and also now a requirement in the law.
Yes, sir. Thank you very much. 2 weeks ago, I sent a letter with Chairman McHenry to Chair Gensler regarding the SEC's climate disclosure rule, urging him to rescind his proposal and reminding him that the SEC is a market regulator, not a climate forecaster. Much like Congress designed the SEC to protect investors, to maintain fair, orderly, and efficient markets, and to facilitate capital formation, and not to advance progressive climate change policies, Congress designed the Federal Reserve to promote price stability and maximum employment, not to play politics. To that end, I find worrying the Fed's announcement of recent actions to consider climate-related scenarios, coupled with remarks by the Vice Chair of Supervision, as attempts to incorporate broader ESG policies into the financial services system. Banks have and continue to account for weather-related risks in their risk management, but efforts that attempt to predict climate change far into the future fall outside the scope of their authority. Importantly, the level of speculation required in these models should highlight their arbitrary and capricious nature. At a time when our economy is suffering from historically high inflation, I expect our central bank to focus its time and resources on bringing inflation down, not on policy outside of its mandate. I noted in my opening statement a recent speech that you've given about the state of the Fed and how you should resist the temptation to broaden its scope and to address social issues. Do you agree that the Federal Reserve does not have the authority or statutory direction to use its monetary policy or supervisory tools to wade into the ESG or other climate policies?
I do. As you know, there's a tightly focused role that we do have that I believe that we have, but I would agree with your statement.
Yeah. Mr. Chairman, I have 20 seconds left, but I'm going to defer because of my earlier question to my opening statement.
Thank you, Senator Scott. Senator Menendez is close, but not here yet. So Senator Rounds. But nice try.
Yes, sir.
Thank you, Mr. Chairman. Mr. Chairman, first of all, welcome. It's always good to have you in front of our committee. And as you know, both core and headline inflation have remained persistently elevated. And over the past 12 months, real average hourly earnings fell by 1.8%, about 4% since President Biden took office. To make ends meet as prices increase, more Americans are leaning on credit cards. At the end of 2022, credit card debt hit a record of $930.6 billion, an 18.5% spike from a year earlier, and an average credit card balance rose to $5,805. Over the past year, the Fed has acted aggressively to tame inflation, and yet we are still seeing price increases. As we've discussed this several times, but I recognize that it's been an ongoing discussion, but I believe that this further proves that we have long been feeling the effects of a policy-induced inflation resulting from decisions by the Biden administration, primarily cutting off the resources necessary to improve and increase domestic energy production. I continue to be concerned that if you attempt to use the tools that are available at this time for the Fed, then I believe that we're going to have a challenge of not being able to address specifically the challenges brought out when you have a policy is promoting higher prices with regard to energy, as opposed to what you're trying to do, which is to bring down the total overall cost. And I just wanted to ask, I guess, and you're going to think this is something that we've heard before, but do you believe that you currently have the monetary policy tools to actually reduce inflation? And I just put it in this perspective. In January of 2021, the CPI was 1.4% when the Biden administration began. In January of 2022, and this is before the Russian invasion of Ukraine, CPI was at 7.5%, 7.5%. Today, March of 2022, CPI is 8.5%. Wouldn't it be fair to assess that a lot of the policy or the inflation that we've seen here may very well be due to policy decisions by this administration?
Senator, not for us to point fingers. Our job is to use our tools. You asked whether we have the tools to get this job done, and we do over time. There are some things that we can't affect, but over time we can achieve 2% inflation, and we will.
In other words, you've got a limited number of tools available to you, and the limited number of tools that you have are designed to impact simply the reduction in prices and so forth. And yet, if there are competing interests out there that are pushing prices higher, you don't have the wherewithal to decide one tool versus another based on whether it's policy induced or whether it is a matter of a shortage in supplies from outside or whether it's war related.
That's right. Our tools essentially work on demand, moderating demand, and so that's what we can do.
So if there were policies in place that actually help to reduce inflation, in other words, and by that I'm just going to look at energy alone just as a good example. If policies were in place that were actually allowing energy prices to come down in the United States, then you would have less of a need to use the very blunt tools that you do have right now with regard to increasing rate increases. Is that a fair statement, sir?
In a sense it is, but I would just say on energy,
I'm not trying to get you to a policy discussion with what the president's doing on his energy policy. I just want to make it clear that you have to respond to what's in front of you, and it doesn't matter where the inflation is coming from or what's driving it up. You're simply trying to bring it back down to that 2% number with the only tools that you've really got.
Yes, but I will say on energy, energy has tended over time to fluctuate up and down, and it's not mainly affected by our tools. So the things we look at are really things that are tightly linked to demand in the U.S. economy. Those we can affect.
And I think just the fact that you've been increasing you've been increasing interest rates, and yet inflation continues to ride up, would suggest, just as you've just indicated, that when you have high energy prices, it's tough to impact that part of it with the monetary policy that you've got available to you.
So we focus on everything, but we also focus on core in particular, which doesn't include energy prices. And what's happened is core inflation has come down, but nowhere near as fast as we might have hoped, and it has a long way to go.
Thank you. One last question. Last June, Vice Chairman of Supervision Michael Barr testified before this committee that he would defend the use of the aggregation method as an alternative approach to the insurance capital standards, the ICS, proposed by the IAIS. As the final compatibility criteria set to come out later this year, can you confirm that you share Vice Chair Barr's views on this AM?
I will confirm that, but I'll have to get back to you on the status of that.
Okay, thank you. Thank you, Mr. Chairman.
Thanks, Senator Round. Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. Mr. Chairman, I want to take this moment to remind my colleagues that there are more than 62 million Latinos that call the United States home. We are the largest minority group in the country. We account for nearly 20% of the United States population. We contribute almost $3 trillion in GDP. Yet Latinos have no representation in the Federal Reserve's leadership. In the 109-year history of the Federal Reserve, there has never been a single member of the Board of Governors or regional bank president who has the lived experience of being Latino in the United States. And in practice, that means that the voices of nearly 1/5 of our country's people are repeatedly drowned out when the Fed is making critical decisions on economic policy. Decisions that affect whether a Latino family can afford their first home, find a job that pays a living wage, send their children to college, save for a comfortable retirement, or get a loan to expand their business. Right now, the Biden administration has a clear opportunity to make history with its next nomination to the Board of Governors. It has identified a number of highly qualified Latino candidates who have dedicated their careers to the fields of economics, who are committed to the Fed's dual mandate, who will preserve the independence of the central bank. The administration has rightly nominated and advocated for a number of diverse candidates with similar qualifications, both at the Fed and elsewhere. But despite having 5 opportunities over the past 2 years to nominate a qualified Latino economist to serve at the Federal Reserve, this administration has repeatedly chosen not to. Representation, or lack thereof, does not happen by accident. It is a choice. And I hope the administration makes the right choice with this nomination. Mr. Chairman, would you say that it is a truism that the United States dollar is the reserve of choice in the world?
Yes, I would.
And that brings us enormous benefits, does it not?
Yes, it does.
Now, 12 years ago, a Republican House brought us to the brink of defaulting on the debt for the first time in history of this country, jeopardizing our credit and the world economy. I'm getting a sense of deja vu because, once again, Republicans are recklessly demanding draconian spending cuts to programs that hardworking U.S. families rely on in exchange for allowing the Treasury Department to pay for spending that Congress, including most of them, have already voted to authorize. If you want to talk about spending cuts, it seems to me that the budget is the time to do that, but not to put the full faith and credit of the United States at risk. Chairman Powell, can you talk about the catastrophic damage a debt default would inflict on the economy?
So I guess I will start, if I can, by saying that these are really matters between the executive branch and Congress. We do not seek to play a role in these policy issues. But at the end of the day, there's only one solution to this problem, and that is Congress. Whatever else may happen will happen, but Congress really needs to raise the debt ceiling. That's the only way out, in a timely way that allows us to pay all of our bills when and as due. And if we fail to do so, I think that the consequences are hard to estimate, but they could be extraordinarily adverse, and could do longstanding harm.
Well, I think that's a mild statement of what would happen. I understand. I didn't ask you to engage in the congressional executive branch roles. I asked you about the abstract question of what happens if you have a debt default. Isn't even this constant fight putting into question the possibility that the United States will not honor its full faith and credit have consequences within the economy?
In principle, it could. I think markets tend and observers tend to watch this and tend to think that it will work out, and it has in the past worked out. So it needs to work out this time too.
Now, seeing your testimony before the committee, is it fair to say that you'll do whatever is necessary to tame inflation?
We serve a dual mandate, and we will do what we can, everything we can to restore price stability while also serving maximum employment.
And primarily that means additional rate increases, would it not? What other tool do you have
That's what we have. The balance sheet, the shrinkage of the balance sheet will continue to, but it's principally rate hikes.
So the question is, when does that part of doing anything necessary to tame to tame inflation, come into conflict with your other mandate of maximum employment?
Not now, when we have the lowest unemployment in 54 years, and where we have a labor market that is extremely tight, extremely. So, but that time could come, but it really isn't now, where we're very far from our price stability mandate, and in effect, the economy is past most estimates of maximum employment.
Thank you, Mr. Chairman.
Thanks, Senator Menendez. Senator Kennedy of Louisiana is recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Thank you to you and your team for helping to save the economy during the pandemic meltdown. For what it's worth, I'm generally supportive of the actions of the Fed right now, and I'm not going to ask you today to blame anybody. When Congress spends money, it stimulates the economy, does it not?
Well, it would depend on whether that's funded by tax increases or not. So if there's a spending that's not accompanied by taxes, would have a net at the margin stimulative effect.
Well, and when Congress borrows money to spend even more, that stimulates the economy even more, does it not?
At the margin, yeah.
Okay. If Congress reduced the rate of growth in its spending and reduced the rate of growth in its debt accumulation, it would make your job easier in reducing inflation, would it not?
I don't think fiscal policy right now is a big factor driving inflation at this moment, but it's absolutely essential that we do slow the pace of growth, particularly for the areas of the budget.
All right, let's try to unpack this then. I'm not trying to trick you. You're raising interest rates. You're raising interest rates to slow the economy, are you not?
Yes, to cool the economy off.
And one of the ways you measure your success, other than fluctuation in gross domestic product, is the unemployment rate. Is it not?
Yes, one of the measures.
Okay. So in effect, I'm not being critical. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability.
No, you're trying to raise
not wages.
You're trying to raise the unemployment rate.
There are a lot of
that mean I know you don't like the phrase, so let me strike it. You're trying to raise the unemployment rate, are you not?
No, we're not trying to raise it. We're trying to realign supply and demand, which could happen through a bunch of channels. Like, for example, just job openings.
All right, let me put it another way, okay? The Economist did a wonderful study. They looked at 10 disinflationary periods in America going all the way back to the 1950s. Disinflation is what you're trying to do. It's a slowing in the rate of inflation. Am I right?
Yes.
In other words, prices don't go down, they just don't go up as fast. Deflation is when prices actually go down. You're trying to achieve disinflation, are you not?
Yes, we are.
Okay. Based on history, in the 10 times that we got inflation down, disinflation since the 1950s, in order to reduce inflation by 2%, unemployment had to go up 3.6%. Now that's history, is it not?
I don't have the numbers in front of me, but yes, the standard has been that there have been recessions and downturns when the Fed has tried to reduce inflation.
Now, right now, the current inflation rate is 6.4% and the current unemployment rate is 3.4%. Now, if history is right, I'm not asking you to again blame anybody, but if history is right, unless you get some help in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
Okay. And to get inflation down to 2.2% based on history, an immutable fact, unemployment would have to go to 10.6%. Would it not?
No, I wouldn't.
That's what the record shows. That's what the history shows.
Yeah, I don't think that kind of a number is at all in
I
play
mean,
here.
I know you're reluctant to admit it, and you don't want to get in the middle of a policy dispute. But I think it's undeniable. It's undeniable that the only way we're going to get this sticky inflation down is to attack it on the monetary side, which you're doing, and on the fiscal side, which means Congress has got to reduce the rate of growth of spending and reduce the rate of growth of debt accumulation. Now, I get that you don't want to get in the middle of that fight, but the more we help on the fiscal side, the fewer people you're going to have to put out of work. Isn't that a fact?
Please answer.
It could work out that way.
Sir?
It could work out that way.
Yes, sir. Thank you.
Thank you, Senator Kennedy. Senator Reed of Rhode Island is recognized.
Thank you very much, Mr. Chairman. Thank you, Chairman Powell, for being here today. We saw in the wake of COVID, the globalized supply chain disrupted significantly, and we're in the process of, in some respects, of rebuilding a supply chain with an emphasis on sourcing in the United States. To what extent did that disruptive supply chain contribute to inflation, and to what extent will the new, if you envision it, the new supply chain that is located in the United States and other friendly countries affect inflation?
So the initial outbreak of inflation was all about spending on goods where people couldn't spend on services. So goods spending went way up, and the global supply chain, many goods are imported. The global supply chain just collapsed, and that was the source of the original inflation. It has now spread over the last 2 years to housing and also to the rest of the service sector. So to your question, we are seeing goods inflation has been coming down for some time now. It's still too high, but it's coming down. Housing services there's in the pipeline. You see the new leases that are being signed, and what that tells you is that in the next 6 to 12 months, we will see that come down. But this big service sector, that's everything else, which is financial services, medical services, travel and leisure, all of those things. That's really where that's the source of the inflation we have now, which had nothing to do with the supply, or not much to do with the supply chains. That's where the challenge is now.
And is there anything that you can do that would target that service area without affecting the other areas?
There's not really. Our monetary policy tools are famously powerful but blunt.
A different topic, and that is, as you're probably aware, the Fifth Circuit delivered a ruling in the Community Financial Services Association versus CFPB that the CFPB's funding mechanism is unconstitutional. Just like the Board of Governors, the CFPB is a bureau of the Federal Reserve. Both the Board of Governors and the CFPB rely on the same source of funds and draw on those funds in virtually identical ways. If the Board of Governors funding structure would be found unconstitutional, what would the implications be for the country and monetary policy?
Well, it would be very significant, but I have to say we have significant responsibilities, but I would be reluctant to comment on a case that's before the Supreme Court.
But it is certainly something that you've had people examine for possible ramifications.
Yes, and the central banks tend to be self-funding because of the way they work, and that's a key factor of our independence.
We've gone back and forth on the impact of rate hikes on workers, and you've indicated previously that wages have not been spiraling upwards necessarily, and that inflation expectations are currently stable. But the impact on increased interest rates are usually felt more by low to moderate income people. Is there any way you can work yourself out of that dilemma?
So where we are right now, of course, is very low unemployment. Wages have been moderating, and they've been doing so without softening in the labor market, without a rising unemployment, really, and that's a good thing. So we really don't know. The current situation is a combination of more typical supply and demand issues, but also just things that we haven't seen before, like the war in Ukraine, like the supply chains that you mentioned.
Right.
So we have many unusual factors, and I don't think anybody knows with confidence how this is going to play out.
Thank you very much, Mr. Chairman. Thank you, Chairman.
Thanks, Senator Reed. Senator Brett, Alabama is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's great to have you here today. Over the past 2 years, we've seen the highest inflation of my lifetime, driving up costs for American families across the board. According to the U.S. Department of Labor, the annual inflation rate in 2021 was 7%, and in 2022, it was 6.5%. According to the U.S. Department of Agriculture, the cost of food went up 10% in 2022. And the real effects of that is moms and dads across this nation that are working to put food on the table for their kids, for their babies, had a harder time doing that. This has devastated hardworking Americans, causing a kitchen table crisis in every corner of our country, as the price of food, energy, and housing have all skyrocketed. In response, the Federal Reserve has raised the Federal Reserve Fund rate more than 4 percentage points. Being far from transient, inflation has remained persistent, high, and well above the Fed's long-run goal of remaining under 2%. In the coming year, what factors and indicators are you paying attention to as you and the Federal Open Market Committee decide on whether to increase rates?
So I'd say a couple things to that. First, we're going to be looking at inflation in the 3 sectors that I mentioned: the goods sector, the housing sector, and then the broader service sector. And we need the inflation that's already underway in the goods sector to continue, and that's really important. In the housing sector, we just need the time to pass so that reported inflation comes down, and it's effectively in the pipeline as long as new leases are being signed at relatively small increases. So we'll be watching very, very carefully, though, at the larger service sector, which is 56% of consumer spending, and more than that of what's currently inflation. So that's one thing we'll be watching that very carefully. Also, we raised rates very quickly last year, and we know that monetary policy, tightening policy, has delayed effects. It takes a while for the full effects to be seen in economic activity and inflation. So we're watching carefully to see those effects come into play. So we're aware that we haven't seen the full effects yet, and we're taking that into account as we think about rate hikes.
So when you're looking at this, obviously not to get into a policy discussion, but if there were an increase of energy production in this country, do you feel like that would help drive down inflation?
Well, I think over time, more energy would mean lower energy prices. But we are very focused on what we call core inflation, because that is what is driven by, really by demand, and our tools are really aimed at demand.
Right, understood. But I feel like the cost of energy is not just what you pay at the pump. It ends up affecting every good across this great nation. Additionally, I'd like to ask you about labor participation. So when you look at the unemployment rate, and we've heard my colleagues discuss people having to be displaced in order for us to maybe get to the inflation rate that we would like as a nation, I'd like to focus on the labor participation rate. So right now it's 62.4%. If there were an increase in people coming back into the workforce, would that be a positive factor with regards to driving us down to the 2% rate that you would want to achieve?
I think that it would. I mean, remember those people coming into jobs.
Yes.
That would be great, because the economy clearly wants more people than are currently working. Of course, those people would then spend more, so it wouldn't be a zero-sum game. But it would be great for the country and great for them if they were to come into the labor force.
Amen. I believe that increasing in capital requirements on financial institutions would have a chilling effect on the economy and the availability of financial services. And last week, I joined many of my colleagues in sending you a letter that expressed concerns that if the Federal Reserve decides to conduct a, quote, holistic review of capital standards, as we heard Senator Scott talk about earlier. So is the Federal Reserve concerned that the impact to the economy of increasing capital requirements on financial institutions at a time when inflation remains persistently high would cause an issue?
So I think it's always a balance. We know that higher capital makes banks safer and sounder. We also know that you will at the margin provide less credit the more capital you have to have. But I think it's never exactly clear that you're at the perfect equilibrium, and it's a fair question, I think, to look at that.
And I know, out of respect for the chairman and trying to stay in my time, I will just end by saying, I heard what you said. Obviously, as you have said, the Federal Reserve is not and will not be a climate policymaker. I just want to thank you for your public statement on that. I agree with you that there's a difference between policymakers and financial regulators, and certainly look forward to working with you in the future.
Thanks, Senator. Senator Warner from Virginia is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you again. Let me start by saying, depending on who's asking questions, we're either pounding you for how quickly we're going to drive that inflation back to 2%, or pounding you on making sure that we don't push the economy into a recession and drive up unemployment. I got to tell you, and it's these are maybe not the cheap seats, but I actually think you've done a pretty good job in terms of both ratcheting up rates and then starting to tail off a little bit. I think we all were concerned by the January numbers where it popped up a little bit more. I wish, Mr. Chairman, we were actually having this hearing 2 weeks from now, because we're going to have a lot more data later in this week and next week. But I want to net. We've still got ways to go, and the January numbers were concerning. But I do think your tailored approach. We can all second guess, but I think it has been the right approach. And I want to commend you on that. I want to get two questions in. One of the areas that I am very worried about is commercial debt. I mean, we've got a Bloomberg story here showing, we're going to hit a $6 trillion wall this year on refinancing. Where I'm particularly concerned is the issue around commercial real estate. As we recover from COVID, a lot of things are getting back to normal, but clearly the transformation of where people work is going through a fundamental transition. And I hope people do return more to the office, but lots of folks prefer working elsewhere. That's going to fundamentally change the real estate market on the commercial side. And I do believe we're going to hit potentially a cliff here of a totally unexpected problem in terms of commercial real estate. How are you looking at that issue and recognizing there's lots of bumps coming out of COVID? This one seems to be more unique in nature. And how are you thinking about that issue?
So the first one on commercial debt, business debt generally, it's kind of been moving sideways as a percent of GDP. So you don't see a big spike going on or anything like that. However, of course, there are pockets of concern, and particularly you pointed to the refinancing spike that has to happen, and I've seen those come and go before. Generally, markets can absorb them, maybe at a much higher rate this time, but it's something that we're well aware of and watching carefully. In terms of CRE, I would agree with you. The occupancy of office space in many major cities is just remarkably low, and you wonder how that can be. Now, over time, some of that's going to be made into condominiums and things like that, since we don't seem to have quite enough housing in some places. But the question is, what's the financial stability risk? It's not great for the largest institutions. Don't tend to have a lot of direct exposure to that. Some smaller banks actually do. Medium and small size banks do. We carefully monitor it. We agree that that's an area that requires a lot of monitoring, and I'd say we're on the case. So,
well, that will morph me into my last question. Something we've talked about, and a lot of my colleagues have talked about with the large institutions. In other words, I mean, I do think even some of the biggest critics of Dodd-Frank, I think, would acknowledge our banking system is a heck of a lot stronger and was able to withstand COVID in a very healthy way. But what we've also seen evolve is a vast amount of financial institutions move beyond the regulatory perimeter. The fact that we now have way over half of the mortgage origination coming from non-financing institutions, because a lot of the large entities, hedge funds, other funds that may be doing some of this commercial debt or some of the CRE debt. I'd like you to talk generally in the last 40 seconds or so of how you think about this regulatory perimeter. I'm a big believer, and I know some of my colleagues are, that that we ought to look less at charter and look at same risk, same regulation, maybe as a guiding principle. And I know Senator Warren's been working on some work. I've been working on some work around crypto around that area. But there's a vast amount of activity that's taking place outside the regulatory perimeter. How should we be thinking about that, and how do we make sure that doesn't create the kind of crisis sneak up that happened in 2008 on the non-regulated side of the house?
I think you articulated the principle very well. It's same activity, same regulation. And that covers crypto and all kinds of other activities. People are going to assume when they deal with something that looks like a money market fund that it has the same regulation as a money market fund or a bank deposit. And so stable coins need some attention in that respect. I just think that's the basic principle. And you're right. So much of intermediation has moved away from the regulated banks really for a long period of time. We got to keep an eye on that.
Thank you, Chair Powell.
We can keep looking at it. I hope it's.
Thank you, Senator Vance. I'm sorry, Senator Hagerty of Tennessee.
Thank you, Chairman Brown, and thank you very much, Ranking Member Scott, for holding this hearing. Chairman, it's great to see you again here. I appreciate your presence, and I appreciate the opportunity to talk with you about an item that I'm particularly concerned about, and that's the holistic review that Senator Britt just brought up that Vice Chair Bauer is conducting right now. It's generating a sense that higher capital requirements are on the horizon for us. And as I think about that in the context of what we've weathered, you think about the situation in 2020, it was an acute real life stress test, if you will. And I think that our financial system navigated that admirably. In the past, Chair Powell, you told this committee that our financial system has proven resilient through 2020 and that the capital levels at that point in time, and I would note that those capital levels are at multi-decade highs, are in aggregate adequate. And I just wanted to follow up on those prior statements and see if you still feel that way.
So I guess I would say it to you this way. In our system, we have a vice chair for supervision who has statutory responsibilities. And when a new vice chair for supervision comes in, generally they're going to want to take a fresh look. And that's what the Vice Chair Quarles did, and that's Dan Chiarullo kind of had the job on an informal basis, and that's what he did. So it's only natural that someone would come in and take a fresh look, and I think that's part of the process. The role of that person is to make recommendations on regulation and supervision to the full board. The role of the board is to consider those when made, and to me, this just comes under that heading.
Well, as the review is underway, and I appreciate that context. One aspect of it seems to us as an apparent willingness to undo the tailoring requirements that were enacted as part of S-2155. And I understand that nothing has been finalized regarding the regulations. It's a concerning prospect if that's the case. The Fed's general counsel just yesterday alluded to undoing 2155 by, quote, pushing down the Basel requirements on banks that were intentionally given relief in that bill. So I want to be perfectly clear that the banking regulators themselves can't just simply ignore or selectively enforce the laws. And again, I realize that the details of the study haven't been finalized and made public, but if the proposal put forth by Vice Chair Barr is either unduly aggressive or appears to contradict the spirit of S-2155, will you vote for it?
I can't answer that in the abstract, of course, but I would say we're, as an institution, very strongly committed to tailoring, and anything we do is going to reflect, tailoring of institutions according to their risk. And I mean, that's a principle that we'll stick with.
I think it's quite important, again, given the legislative intent here and the concerns that we maintain that in the face of what General Counsel said just yesterday. I appreciate your perspective in terms of keeping that in place. I'd like to come with my next question, Chairman Powell, with starting the question by underscoring the importance of the independence of the Fed's monetary policy. Right now, the economic picture is about as uncertain as I can remember. We've had large companies in the private sector who are in the midst of planning layoffs and forecasting serious economic weakness in the quarters to come. Yet, on the other hand, the current economic data seems to be robust. Inflation showed some signs of softening in the past several releases. So I just hope, Chair Powell, that you could briefly tell us how you synthesize these seemingly contradictory data.
So just quickly, at the end of last year, we saw a couple of very promising, modest inflationary readings in November and December. But earlier this year, some of that improvement was revised away. In addition, we got a very strong reading on inflation in January, also a very strong jobs reading, also very strong retail sales. And so, as I pointed out in my testimony, we're looking at a reversal, really, of what we thought we were seeing to some extent, a partial reversal. It's still true. It's still the case that we're seeing progress on inflation. We're seeing goods inflation has come down significantly. There's improvement in housing inflation in the pipeline. There's not a lot of improvement yet to be seen in the largest sector, which is non-housing services. So inflation's running core inflation is running at 4.7% on a 12-month basis. I think nothing about the data suggests to me that we've tightened too much. Mm-hmm. Indeed, it suggests that we still have work to do.
In that context, thinking about where the tightening goes and when it might, where and when it might happen, where do you see the terminal Fed funds rate landing in this cycle?
So we last wrote down our assessments, individual assessments of that in December, and I think the median range was basically people were clustered between 5 and 5.5. We're going to write down those again as part of them. We do it 4 times a year. We'll do it around the March meeting, which is on the 21st and 22nd of March. And as I indicated in my testimony, I think the data we've seen so far, and we still have other data to see, we still have significant data to see before the meeting, suggests that the ultimate rate that we write down may well be higher than what we wrote down in December.
Got it. Thank you, Mr. Chairman.
Thank you.
Thank you.
Thank you, Mr. Chairman. So the Fed has raised interest rates 8 times over the last year in what has been the most extreme rate hike cycle in 40 years. The Fed's goal is to slow inflation, and your tool, raising interest rates, is designed to slow the economy and throw people out of work. So far, you haven't tipped the economy into recession, but you haven't brought inflation entirely under control either. And maybe the reason for that is that other things are also keeping prices high, things you can't fix with high interest rates, things like price gouging and supply chain kinks and a war in Ukraine. But you are determined to continue to raise interest rates, so I want to take a look at where you're headed. In December, the Fed released its projections on the state of the economy under your monetary policy plan. According to the Fed's own report, if you continue raising interest rates as you plan, unemployment will be 4.6% by the end of the year, more than a full point higher than it is today. Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me. I will say it's not an intended consequence.
But it is, and it's in your report, and that would be about 2 million people who would lose their jobs, people who are working right now, making their mortgages. So, Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it.
Well, will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Let me ask you about what happens if you do this. Since the end of World War II, there have been 12 times in which the unemployment rate has increased by 1 percentage point within 1 year, exactly what you're aiming to do right now. How many of those times did the U.S. economy avoid falling into a recession?
You know, it's not as black and white as very
Just
very
looking
infrequent.
at the numbers, it actually is pretty black
Alan
and white.
Blinder's written a book on this, and
There have been 12 times that we've seen a 1 point increase in the unemployment rate in a year. That's exactly what your Fed report has put out as the projection and the plan based on how you're going to keep raising these interest rates. How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exactly right. So then the question becomes, we've got 2 million people out of work. Can you stop it at 2 million people? History suggests that the Fed has a terrible track record of containing modest increases in the unemployment rate. Once the economy starts shedding jobs, it's kind of like a runaway train. It is really hard to stop. In fact, in 11 out of the 12 times that the unemployment rate increased by a full percentage point within 1 year, unemployment went on to rise another full percentage point on top of that. If that's what happens this time, we'd be looking at least 3.5 million people who would lose their jobs. So, Chair Powell, if you reach your goal and 2 million people get laid off by the end of this year, and then, just like in 11 out of 12 times that unemployment has risen by a point in a single year, it keeps on rising. And then we've got 2.5 million people out of work. We've got 3 million people who get laid off. We've got 3.5 million people who get laid off. What's your plan?
Well, right now, the unemployment rate is 3.4%, which is the lowest in 54 years. And we actually don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control.
I'm looking at your projections. Do you call laying off 2 million people this year not a sharp increase in unemployment?
I would say 4.5%.
Explain that to the 2 million families who are going to be out of work.
We're not targeting any of that. But I would say even 4.5% unemployment is well better than most of the time for the last 75 years.
In other words, you don't have a plan to stop a runaway train if it occurs. Chair Powell, you are gambling with people's lives, and there's a pile of data showing that price gouging and supply chain kinks and the war in Ukraine are driving up prices. You cling to the idea that there's only one solution: lay off millions of workers. We need a Fed that will fight for families. And if you're not going to lead that charge, we need someone at the Fed who will.
Senator Vance of Ohio.
Thank you, Mr. Chairman. Chairman Powell, thanks so much for being here. I have a question that's slightly far afield, but how often do you get to talk to the Federal Reserve Chairman? So I might as well ask it. So to give some context here, my family comes from Appalachia. Particularly, my grandparents grew up in southeastern Kentucky, coal country, and then moved to southern Ohio, where I now have the honor of representing all of Ohio. And one of the things that you hear a lot when you study the regional history of Appalachia is it's often described as possessing a resource curse, right? So there's a lot of coal in central Appalachia that enables a certain amount of consumption. Obviously, consumption is good. People need food and medicine and other things. But there's also a pretty good argument that for a host of reasons, it causes malinvestment in the region. And consequently, you have lower productivity growth, lower innovation, and an economy that's much less diversified and much less dynamic. I'm wondering, when I hear about the history, when I think about and read about the history of Appalachia and the resource curse, I'm struck by some of by the idea that you could make a similar argument about the reserve currency status of the United States dollar. Americans have enjoyed one of the greatest privileges of the international economy for the last nearly 8 decades, a strong dollar that acts, of course, as the world's reserve currency. You know that better than I do. Now, this has obviously been great for American purchasing power. We enjoy cheaper imports. Americans, when they travel abroad, benefit from lower costs. But it does come at a cost to American producers. I think in some ways you can argue that the reserve currency status is a massive subsidy to American consumers, but a massive tax on American producers. Now, I know the strong dollar is sort of a sacred cow of the Washington consensus, but when I survey the American economy and I see our mass consumption of mostly useless imports on the one hand and our hollowed out industrial base on the other hand, I wonder if the reserve currency status also has some downsides and not just some upsides as well. And let me just put a final point on this, and I'd love to get your thoughts on that, Chairman Powell. We're, of course, now the main supporter of a massive land war in Europe between the Russians and the Ukrainians. I read recently, and I'm not going to comment on how perfect or precise these estimates are, but I read recently that the United States is trying to ramp up production from 14,000 artillery shells to 20,000 artillery shells. That's per month, while the Russians are firing 20,000 artillery shells in Ukraine per day. And when I look at the American economy, we have a lot of financial engineers and a lot of diversity consultants. We don't have a lot of people making things. And I worry that the reserve currency status and the lack of control we have over our currency is perhaps driving that. I'd love to get your feedback on that. What are the upsides and downsides of the reserve currency?
That's a big question to try to answer.
You have 2
here
minutes,
today.
Chairman Powell, so plenty of time.
I can't even get started on that. So we are the world's reserve currency, of course, and that's because of our democratic institutions. It's because of our control over inflation over many, many, many years. The world trusts the rule of law in the United States, and those are the things. So once you're the world's reserve currency, it's used in all over the world in transactions, and it's the place where people want to be in times of stress, is in dollar-denominated assets. Now, so of course we benefit by being able to pay for our goods all over the world, pay for everything anywhere in the world, mostly with dollars. That's an advantage. There's some economic theory around that it also has burdens of various kind, but I can't call it all back to mind. But the other thing is, it's a very stable equilibrium, but it's not a perfect one. It's not a permanent one, rather. So there isn't any obvious candidate to replace the United States right now, where you can have free flow of capital in and out of the country, where you can really trust the rule of law and democratic institutions, and keeping price stability, which you can here.
Do you think it gives us less control over our own currency, the fact that it's become the world's reserve currency?
Control over our currency. I'm not sure. So essentially what we try to control is price stability. And no, it doesn't make it harder for us to keep inflation under control. The United States has a smaller external sector than most large economies, where it's only about 15%. So mainly what affects inflation in the United States is domestic supply and demand.
Do you think it makes it harder for us to affect and to fight back against currency manipulation, to control the export and import flows in a way that stabilizes our own manufacturing sector?
Well, I mean, what's important there is really the level of the dollar, and when the dollar is stronger, obviously our wares are more expensive abroad and that kind of thing. But we don't have an opinion on matters of the level of the dollar really matters for the Treasury Department and the elected government, not for the Fed.
Thank you, Chairman Powell.
Thank you, Senator Vance. Senator Van Hollen of Maryland's recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here and for your service. I know the Fed is experiencing lots of challenges these days. I've got a couple questions that are just, I think, basic yes or no's, and then some longer questions. Would you agree that changes in the size of corporate profits can be one of the factors that affects the inflation rate?
Yes.
Right. Now, recently, we saw that the Employment Cost Index, which, as you know, measures the growth of wages and benefit costs, grew at roughly 4% on an annualized basis in the fourth quarter of 2022. Is that right?
That's my recollection, yes.
So if corporate profits were to decline from the extremely high levels that we saw recently, would it be possible to sustain the 4% growth rate in the Employment Cost Index for an extended period of time, even as we get inflation down to the target of 2%?
Depends on what you mean by extended period of time. So you would not, without a very, very large increase in productivity, which would be great, but that we don't expect, you wouldn't be able to sustain 4% wage inflation over the longer term. Over the shorter term, though, yes.
So over the shorter term, that would not be a justification in and of itself for raising rates. Is that right, in the short term?
Well, I think wages affect prices and prices affect wages. I think we do think that some softening in labor market conditions will happen as we try to get inflation under control, and will need to happen.
Right, but that's more a prediction about your efforts to fight inflation. Are you saying that simply looking at the current 4% growth rate in the short term is an excuse for jacking up interest rates?
I think what I would say is that all the data we look at in the labor market, including not just that measure of wages, but others, also unemployment, also participation, also job openings and quits and things like that. All of that, you put that into the picture, and I think you see a labor market that is extremely tight and is probably contributing to inflation. I've never said it was the main cause.
I think the larger point here, based on your response to that first question about growth in profits, is corporations have a decision as to whether or not they're going to pocket more for profit, which they can, or provide higher wages to their employees. And if you actually lowered your profit margins, you could sustain a higher wage increase without violating the 2% inflation. Isn't that right?
Yes, I mean, when I hear profit margins, what we're seeing in the economy is pretty much about shortages and supply chain blockages. And when there's not enough of a product, what happens, and there's a lot of demand, what you see is prices going up as the supply chains get fixed and shortages are alleviated. You will see inflation coming down. You'll see margins coming down, and that will certainly help with inflation.
Right, but profits are the margin, right? They're going up beyond what they were before. That means that even with the increase of costs because of supply chains, they're making more profits. Which again, that they can do that. But my point is that as a contributor to inflation, as you indicated in response to the first question, let me ask you about the tight labor market because one of the issues in the tight labor market is parents with kids, including a lot of moms who would like to go back into the market, but are not able to do so because of lack of affordable childcare. The other issue is immigration. And I know that you've gotten some recent data on how some immigration figures actually have softened a little bit the tightness in the labor market. Can you just talk broadly about those two factors, affordable childcare and immigration, more legal immigration, and how they could affect labor force participation and therefore also reduce inflation pressures?
So on the first, we don't make recommendations or evaluate fiscal policy, but I will say there's research that shows that it helps keep women in the workforce when there's childcare available, which is, I think, kind of self-evident. Sorry, the second was
impact of immigration.
Immigration, yeah. So what I talked about with you is actually as part of the January Bureau of Labor Statistics report, which comes the employment report for January, which comes out in early February. There is a section in there about more people. The Census Department has increased its estimate of the workforce by something like 870,000. And a significant part of that has been immigration. So, and that has moved up participation by a little bit, but it may be part of why we're hearing. It may be part of why we're hearing from in the labor market that the really intense labor shortage pressures that we were hearing about in 2021 and 22 may be alleviating. So that would contribute to that. Clearly, more people. Clearly, the economy is calling for more people with essentially two job openings for every unemployed person, and this can be a source of those people.
Right, and that would reduce the tightness of the labor market and reduce pressures on inflation. Right,
may already be doing so.
Thank you.
Senator Kramer of North Dakota is recognized.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. And I can't resist responding to a few things that my friends on the left have said. For example, in his opening statement, Chairman Brown had a long list of things that raising interest rates won't do. Raising interest rates won't fill in the blank. I'm going to fill in the blank with a couple things. How about raising interest rates won't stop Senate Democrats and President Biden from overtaxing, overspending, overborrowing, overregulating? Chairman Brown said we should rebuild our supply chain by curbing offshoring, corporate offshoring. I agree. He talked a lot about corporate greed contributing to inflation. Okay. But how about regulatory greed contributing to corporate greed? How do you expect corporations to reinvest money if you overregulate their ability to invest that money right here in the United States of America? You want to onshore some things? How about energy policy? How about instead of looking to Venezuela or Iran for oil supply or Russia, or rather than looking to China for electric vehicles and chips and solar panels, how about we have a strategy that onshores those things by reducing regulation, reducing taxes, letting those corporations reinvest their profits rather than stock buybacks or dividends. This idea that somehow the Federal Reserve is supposed to keep inflation in check while half of the government works against it is mind-boggling. Now, I know, Mr. Chairman, you don't like to comment on policy. You and I have been around and around about this. You were anxious to advise us to spend lots of money during the pandemic. I don't think a lot of people blame you for that. You wouldn't respond to efforts by the Biden administration after we were in a robust recovery from not spending so much money. Okay, I can appreciate the change. But now we're in this debate between Republicans and Democrats, between particularly the House Speaker and the President, on how to raise the debt ceiling. And you've made some pretty strong comments about raising the debt ceiling, absent from structural reforms that would actually help us get back to a reasonable growth. So I warn you again, if you're going to make political comments, if you're going to advise us on policy, be consistent with it. Now, I want to get back to the greening of the Federal Reserve and these, I call them stress tests. You can call them whatever we call them. But I'm concerned that now the Federal Reserve is starting down this path. Maybe it's slightly at first about climate stress testing. I just want to ask you this. If we're going to go down that path, if the Federal Reserve is now going to become part of the federal climate police force, are we going to consider the ramifications of having entire communities and economies, factories and manufacturers, whatever energy entities, large server farms, leaving them susceptible to a very unreliable, very expensive energy source? Is that part of the stress test?
No, those are considerations for elected people, not for us. We have a narrow role to play here, but it's a real role, and I can talk about that if you'd like.
Well, yeah, I would like you to, because again, if we're gonna start doing stress tests for the 6 largest financial institutions related to climate, which really is more weather than climate, then are we going to consider the effects of an unreliable energy source at several locations throughout our country?
So our only focus is on the safety and soundness of these institutions, and do they understand and can they manage all of the risks that they run in their business model. That's our only goal. We're not looking to be climate policymakers. Climate policy is clearly going to have effects on regions, on companies, on individuals, on countries, disparate effects. And that is not for unelected people like us who have a narrow mandate, but I think it does touch climate. And you're right to be concerned that we find ourselves on a slippery slope. But honestly, I think the climate scenarios are something that the banks are already doing and themselves, and the climate guidance is something that they're looking for. They want to know how we're thinking about this, but we will try really hard not to get on a slippery slope and find ourselves becoming climate policymakers. It's just not appropriate for an independent agency.
Okay, and I completely agree, and I hope you stick to that. And I think you ought to ask the banks to consider what the overreaction might, what kind of vulnerabilities that might expose. With that, with regard to what Senator Warren was saying on her monologue, one thing about ideologues, they have the luxury of binary choices. You have a really big job, and you have a single, in my mind, one and a half, maybe two missions. I think the first one handles the second one okay, but it's got to be tough when the White House is working against you and you don't have to comment. Thank you. Thank you, Mr. Chairman.
Senator Tester of Montana is recognized.
Chair Powell, thank you for being here today, and thank you for serving in this critical role at this critical time. I have talked many times in this committee, and I, especially right now, cannot overstate the importance of the Fed's independence. I said it in the previous administration. I say it now. We cannot be playing politics with our economy, and that is a fact. From a climate standpoint, I would just tell you it's entirely artificial right now anyway, because if you look at the hundreds of billions of dollars this country puts out every year in disasters due to climate instability, we ought to be asking our question, is that sustainable? Because quite frankly, it has to be done, and I don't think it's sustainable. So we've got to start looking for some solutions on the climate side sooner rather than later. The Reserve has a tough job, and I really appreciate how you've done it. Reasonable, working together, making hard decisions for the good of the economy. We have to get this right. So the question is, how much has inflation decreased since its peak?
It depends on the measure, but it's meaningfully, at least a couple percentage points.
Okay, and has unemployment gone down as inflation has gone down?
Unemployment has gone down. Yes, it has, to now a 54-year low.
Yes. So the question becomes, and I always think back to in 1998, I bought some property, and the interest on that property was 10% in 1998, and I thought I got a hell of a deal. By the way, I thought it was just great. But the truth is interest rates have been artificially low for the last 20 years, probably. And the question becomes, as you look at the economy and as you try to make the determination whether the inflation is caused by demand or supply, where does all that fall in to your decision making moving forward?
Well, you mean the level of interest rates? So in theory, there's this thing called the neutral level of interest, and we know it only by its works. And neutral is the level that neither pushes the economy up nor pulls it down, and it changes over time. This is the thing about these important variables in economics. So what's happened until now was that the neutral level of interest went down and down and down to the point where, many countries had zero interest rates and very low inflation. Now we have this a series of shocks associated with the pandemic, and we have rates at 4.5%, our policy rate, and we have the labor market very strong and inflation reacting somewhat, and it does raise the question of where's the neutral rate. Honestly, we don't know. I think we look at the current situation and we see that there's not a lot of evidence hard to make a case that we've over tightened. It means we need to continue to tighten. I think we're very mindful of the lags with which our policy works. We don't think we need a significant increase in unemployment, and we're certainly not aiming for one. But we do think there'll be some softening in labor market conditions to get to 2% inflation.
When you're looking at interest rates, I know we talk about energy prices here and the price of gasoline, and then if you go over and Europe is much higher. Are we comparable? I'm just curious. Are we comparable with our interest rates here as with, say, Europe?
We're very close to where Canada is. We're a little bit higher than where Europe is. Europe's traditionally had much lower inflation. They now have very high inflation, and they're still increasing rates, but they're a bit lower in terms of rates.
So if we do not get the inflation under control, and like I said, I think the steps you've taken have been reasonable and measured. If we don't get it under control, what are the impacts of that?
Well, the social costs of failure is one way to think about it, are very, very high. So if inflation were to continue, at some point that will become the psychology. People will come and businesses will come to expect high inflation, and that will make it more self-perpetuating. That will mean an up and down economy. It'll mean it'll mean something that looks more like what we've seen in periods of high inflation. Capital allocation is difficult in a world like that. It's not a good time for the economy. What we want to do is restore price stability firmly back at 2% so that we can have the kind of strong labor market for a sustained period that we had before.
Once again, thank you for your work. Thank you for your independence. Senator Daines.
Thank you.
Thank you, Senator Tester. I'll be handing off to Senator Cortez Masto when I'm finished up as well. So, Mr. Chairman, good to have you here today. When I am back in Montana, the number one issue I hear, certainly across the state, is the high cost of gas, the high cost of groceries, and overall how their paychecks are shrinking because of inflation. It's a crushing blow. It has real life impacts. It's top of mind issue for Montanans. It's also important to note the devastating impact it's going to have on our nation's economic future. In fact, in October of last year, I sent a letter to Congressional Budget Office Director Swagel regarding the impact that high inflation and the elevated interest rates would have on the cost of servicing the federal debt. His response painted a less than rosy picture. But then we got the CBO's updated 10-year baseline forecast in February, and it confirmed the truly dire situation that we find ourselves in. Driven by interest payments on the debt, the CBO now projects that cumulative deficits during the 10-year window, and I recognize where deficits come from. It's irresponsible spending here in Washington, but the cumulative deficits during the 10-year window will exceed $20 trillion. The cumulative deficits, not talking the debt, because it's going to grow the total federal debt to more than $51 trillion by 2033. Now, 2033 used to sound like a long ways away. We're 10 years away. 10 years goes by very, very quickly. Within 5 years, we're going to spend more on annual interest on the national debt than we spend on national defense. You think about that for a moment. And these are coming out of the CBO. These absolutely shocking, but quite frankly, predictable projections go back to a debate we vigorously had here in the banking community. I remember when Lawrence Summers, of course, the former Secretary of Treasury under President Clinton, economic advisor to President Obama, he warned us. He said, he was practically warning my colleagues across the aisle, says you can't move forward with these purely partisan, at that time, a $1.9 trillion spending extravaganza. We had $1 trillion of unspent COVID money in December of 2020. And that passed on a purely partisan vote. We said it's going to start to ignite the inflation fires. So I certainly hope the president's budget, which we expect to see later this week, will propose pro-growth policies that can get us out of this mess. And I would argue almost an existential crisis as we look at what's going to come at us here, of course, the next 10 years with debt and service on that debt. Unfortunately, as the president said in the State of the Union address, the president says he's going to raise taxes. That's a recipe for disaster. It's going to crush productivity, discourage investment, stifle economic growth even further. I want to turn to my questions now, Chairman Powell. You're raising interest rates to combat the inflation we've seen in the economy over the past few years. Is that correct?
Yes.
And although this is the domain of Treasury, a higher Fed's fund rate will mean higher borrowing costs. Is that correct?
Yes, all else equal.
So I just want to connect the dots here around inflation was sparked. One of the big reasons was massive spending here in Washington. And now we're going to be bearing the challenges with higher debt service over the course of the next several years, where we're going to see debt service exceeding defense spending, which is we see the threats of China, threats around the world. I think it's very, very concerning. Now, as a grandfather of 4, soon to be 5 grandchildren, these things you think about more and more as you look forward. I want to change here and talk about American energy. When the war in Ukraine broke out, many feared that Russia would cut off natural gas exports and cause energy inflation to spike. Prices didn't spike as much as anticipated, due in large part to the fact that American companies stepped up to the plate. As of late last year, the European Union now receives more liquefied natural gas from the United States producers than it does from Russian producers. That's a good thing for the world to see more U.S. produced energy. Chairman Powell, do you believe that European and American inflation would have been manageable if not for American energy producers?
I certainly think that particularly our natural gas assets have helped Europe make the transition.
Any sense of how much worse the global energy picture would be if you would imagine a world where we're not producing and shipping energy to other countries?
It'd be hard to estimate.
Probably worse.
Yeah, I mean, I think it's been clearly Europe has managed better than expected, and a part of that story is just U.S. energy exports. Also, the winter wasn't as bad, and the Germans made some good decisions.
Yeah, we made some prayers that says we need to pray for a warm winter for Europe, and I think they got one, which was something that's been helpful. I'm out of time here. I'm going to send this back over to Senator Cortez Masto.
Thank you. Chairman Powell, it's great to see you. Thank you so much. I know it's been a long morning Always appreciate you coming to talk with us here on the committee. I want to first align myself with the remarks from Chairman Menendez supporting a Latino nominee to the open seat on the Federal Reserve. It's been more than 100 years, and a Latino has never served on the Federal Reserve Board. And I know there are many strong Latino economists and economic experts who would capably serve. So I want to put that out there. Chairman Powell, I also sit on Senate Finance. Right across the way, we were talking about affordable housing. I think for purposes of so many of us across the country, including in Nevada, when we talk about affordable housing, it's also about workforce housing. It's about making sure families that are working so hard have an opportunity to keep a roof over their head. Right now in Nevada, if you're making minimum wage, you have to work 75 hours a week just to be able to afford housing. And so I want to talk to you about this. I was distressed to see in the report that that activity in the housing sector has contracted as a result of the elevated mortgage rates, and you've been talking about that. I often hear from Nevadans who say, I don't know if I'm ever going to own a home, and many feel resigned being stuck in a cycle of renting. So, Chairman, how do the Federal Reserve economists and leaders think about the balance between keeping interest rates low to spur that affordable home building and home buying while addressing inflation?
We have a dual mandate from Congress, as you well know, which is maximum employment and price stability. And that's really what we take into account. We don't, and of course, interest-sensitive spending is the thing that gets the most support when we cut rates, and the thing that is most affected when we raise rates. And that means housing to a significant extent. That's not a choice that we make. That's just the way it works. And we only have really one tool, which is monetary policy. So, you know, we don't really try to use our tools to affect broader housing policy, but really just to achieve our statutory goals.
It happens to just unfortunately be in effect as you try to achieve your statutory goal. Is that?
Yes.
Yeah.
Yes.
And so I want to have you have the opportunity to address Senator Warren's conversation with you earlier about the tools that you have and the impact that it has on causing potentially more people to be unemployed. And this obviously has an impact on their ability to afford homes as well. Can you address that?
I'd be glad to. I want to be clear that we do not seek, and we don't believe we need to have a very significant downturn in the labor market. And it's not just hope. I think if you look at the situation in the labor market, you've got all these job openings, and in principle, you could reduce the job openings without seeing a really significant increase in unemployment. Also, you're starting from such a strong labor market. It seems as though you're a long way away from anything that looks like a recession, just looking at the labor market by itself. So honestly, we don't know that we need that there will need to be a really significant downturn. Other business cycles had quite different backstories than this one, and we're going to have to find out whether that matters or not. But I do think that I've said all along, my colleagues and I have too, that we believe that we can. There's a path to restoring 2% inflation with less significant effects on the labor market than have typically been seen in downturns.
And for purposes of the general public, people, Nevadans that I know that are struggling, we have one of the highest, we've talked about this, and thank you for always being willing to talk with me. We have one of the highest unemployment rates in the country. Our service sector was hit so hard. We're still at over 5% just in Southern Nevada. We have high gas prices. We have grocery prices. We have housing prices that are high. So one of the things that you have commented on, and you just did again, but I know it was in your opening remarks that, and it's quoted right here, and let me just say, our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer term inflation expectations well anchored. For the general public, for those working families and people, why 2%? Why is getting it to 2% so important?
So that has become the globally agreed, essentially all major central banks target 2% inflation in one form or another. How
does that help my Nevada families? How does that help people in Nevada?
I'll tell you how it does. And it's I guess it's obviously not, it's not obvious how that is, but 2% inflation, to have people believe that inflation is going to go back to 2% really anchors inflation there, because the evidence is and the modern belief is that people's expectations about inflation actually have an effect on inflation. If you expect inflation to go up 5%, then it will. If everyone kind of expects that, because that's what businesses and households will be expecting, and it'll kind of happen because they expect it. So having a 2% inflation goal, which we had for many years, de facto we had it, then we formally adopted it in 2012. But for years before that, we were effectively targeting 2% inflation. And what that meant was that inflation, it's one of the reasons why inflation was low and predictable, is having a real target and sticking to it, not changing it, at convenient moments. So we think it's really important that we do stick to a 2% inflation target and not consider changing it. We're not going to do that. It just is, people will be better off if the whole question of high inflation is just not part of their lives. That's kind of the definition of price stability. It's if people live their lives without having to think about inflation all the time.
Thank you. I notice my time is up. Thank you so much, Senator Lummis.
Thank you very much, Madam Chairman, and welcome, Chairman Powell. When you're setting these rates and making these decisions and seeking that 2% magic number, are you considering the cost of borrowing for the United States, knowing that Congress has over borrowed and that we have overspent and that the national debt is at now at least 97% of GDP, and that we're going to face challenges of our own making? This is not about what the Fed has done. This is what about the Congress has done that you have to factor in to your decisions. Do you think about the costs of borrowing for the United States itself?
No, we do not, and we're not going to. In other words, that would be fiscal dominance. If we were, constrained in our monetary policy by the budgetary situation of the United States, and we're not. We're clearly not. The path we're on is not sustainable, but the level of debt that we have is not unsustainable. Is sustainable. Put it that way. So we don't think about interest costs when we make monetary policy. We think about maximum employment and price stability.
It's your opinion that the level of debt we have is sustainable?
Yes, I mean, we could clearly we have the largest economy in the world. We can service this debt. That's not the problem. The problem is that we're on a path where the debt is growing substantially faster than the economy, and that's kind of by definition in the long run unsustainable. And the way countries have gotten or fixed that is with longer term programs that have bipartisan support and that address the actual problem in the budget. That's really the formula.
Thank you. I'm going to switch to stable coins. You're a member of the President's Working Group on Financial Markets. The working group called for bank-like regulation of stable coins in late 2021. Then on January 3rd of this year, in a joint staff statement, the federal banking agencies stated that even after the bank's capital, BSA, AML, and risk management, a bank issuing a stable coin on a quote open, public, or decentralized network is highly likely to be inconsistent with safe and sound banking practices. I'm going to say that again. Even after a bank's capital, BSA, AML, and risk management, a bank issuing a stable coin on an open, public, or decentralized network is highly likely to be inconsistent with safe and sound banking practices. So I'm a little confused about where we're heading on stable coins. Does the January 3rd statement mean that the Fed has decided that stable coins on a permissionless distributed ledger have no place in banks?
So I think that there are real concerns about permissionless public blockchains. And the reason is that they've been so susceptible to fraud, to money laundering, and all of those things. So I think what you heard from the federal banking agencies in one of their reports was that they would tend to look at those as not consistent with safety and soundness.
And what about properly regulated stablecoins? Do you think they could have a place in our banking system?
I certainly think that in a world of appropriate regulation, where the same activity, where stablecoin activity gets the same regulation as comparable products in different places, then there certainly could be a place for stablecoins in our financial services sector.
Thank you. The European Union, UK, Australia, Switzerland, Singapore, and others have all moved over the last few years to create a legislative framework for digital assets. The European Union in particular is attempting to be a standard setter again, like it was with its data protection rule. Is the United States in danger of being a rule taker, not a rule maker when it comes to digital assets?
I do think it would be important for us to have a workable legal framework around digital activities. I think that is important and something Congress, in principle, needs to do, because we can't really do that.
Yeah, thank you. Senator Gillibrand and I agree with you. One area we've already seen is in the Basel Committee on Bank Supervision. They propose prudential treatment for crypto assets framework, setting forth banks' capital standards for digital assets. The Basel Committee's framework does not impose a capital charge for digital asset custody, whereas the SEC's Staff Accounting Bulletin 121 imposes a prohibitive capital charge through the back door and places consumers at risk in bankruptcy. Similarly, the Basel Committee framework allows banks to issue or hold digital assets on their balance sheet if the requisite capital is set aside. So back to January 3rd, 23, the Fed and other bank regulators have said that it is forbidden for a U.S. bank to conduct these activities no matter the capital. So my question is, what does the rest of the world know about digital asset regulation that we do not, that the Fed does not?
So as we discussed, this is an SEC staff accounting bulletin, and it's not something that the Fed issued, and I'd be loath to comment directly on it.
The issue is, and what concerns me, is that the Fed and other federal banking agencies are not following international norms on digital asset regulation. That's just my comment. Thank you, Chairman Powell, for being here. I now recognize Senator Smith.
Well, thank you. And Chair Powell, it looks as if Senator Britt and I are the last people standing at this committee hearing. Thank you for passing on the gavel to Senator Lummis. And I want to thank you for your service and for our recent conversation. And before I get into my questions, I would just like to note there's been a good back and forth amongst our committee around some of the big economic challenges and opportunities that we face in this country. And I would just like to note that the programs and the spending that the ranking member and some of our colleagues have blamed for inflation provided critical relief that kept working families and small businesses afloat during a global pandemic. And in fact, many of these policies were passed on a bipartisan basis and signed into law by both Republican and Democratic presidents. And I also just want to add that the laws that the Democrats passed to lower prescription drug costs and healthcare costs and to lower energy costs for Americans are helping to lower basic costs for families, all of which, by the way, was fully paid for. So I return, Mr. Chair, to what you have said to me privately and to all of us publicly, which is what we ought to be looking for is striving for bipartisan solutions to find a path forward. And in fact, Senator Lummis and I were just talking about this yesterday when it came to housing policy. So just want to put that out there. When you and I spoke yesterday briefly, we talked about the Community Reinvestment Act, and I know that I appreciated the chair raising this point earlier in the hearing. But I want to just return to that briefly. I am very glad to see it's been about a year since the Fed and the OCC and the FDIC issued the proposed rule to modernize implementation of the Community Reinvestment Act. I don't think that the proposal was perfect by any means, but it does make really important improvements to how, through the CRA, financial services organizations can serve and meet the needs of communities that are full of assets, but lack the resources to make it happen like wealthy communities can. So I think, Chair Powell, you indicated that you expect this new CRA rule to be finalized in the coming months. Is that what you indicated?
Yes, that's right.
And can you just tell us, with the departure of Dr. Brainerd, who will be spearheading the CRA efforts?
So I've asked Vice Chair Barr to be responsible for moving the project forward. Of course, it has to go to the whole board,
right?
And everyone gets a vote on that, but he'll be pushing it forward.
That's great. Thank you. I was glad to see that disaster preparedness and climate resiliency were added to the definition of community development activities that would be eligible for the CRA credit. And this is important, of course, because low and moderate income folks and the communities that they live in often face some of the worst impacts of climate change and extreme weather events. This isn't social engineering. This is dealing with the actual costs and challenges that people experience because of climate change. So, Chair Powell, can you talk to us a little bit about how you see that change and how it fits with the CRA's overarching objectives?
So I think it fits for the reasons that you said. Honestly, I'm a week or so away from getting a briefing on where the proposal lies. So I'm reluctant to touch on. I mean, I'd rather wait till after I'm fully briefed on where that agreement came out after the FOMC meeting. So.
Thank you. That's fine. I'll look forward to continuing this conversation with you and with Mr. Barr, and just appreciate this. I think, my view of this is that climate change and the economy are inextricably linked. And the reality is that climate-related action or inaction has a direct financial impact on people and our economy. I was wondering if you would just be willing to update us briefly on some of the next steps that the Fed is going to be looking at as you evaluate the resilience of financial institutions with respect to climate risk. There's this pilot project that just was started in January, I think it was, of this year, and I'm curious to know how you see next steps there.
So we're doing really two things. One is we are doing a climate stress scenario, which the banks are already doing, the large banks, the 6 that we're working with. And that's really just to begin the process of understanding the risks that are associated with this over the longer term. They're already doing it. And it's something that there's a lot of learning going on around the world, actually. The other thing we're doing is providing guidance. The banks want clear guidance. They actually want one set of rules globally. The big banks that do business around the world, they're hoping that they aren't in a world where there's just different regulatory regimes everywhere they go. So we're kind of working on that as well.
Great. Thank you very much, Mr. Chair.
Thank you.
Thank you, Senator Smith. Senator Tillis of North Carolina is recognized.
Thank you, Mr. Chairman. Chair Powell, thank you for being here. In your opening statement, I was here for that. I think you touched on some of the interest rate sensitive components of GDP and non-interest rate sensitive components of GDP. I think you said that we do have a concern in the latter group: inflation expectations, labor market tightening, et cetera. Can you tell me a little bit about how you're looking at the interest rate sensitive and non-interest rate sensitive readings, and whether the Fed, what sort of Fed actions can take place to avoid a zero landing?
Sure. So on, the housing sector, of course, is interest-sensitive spending is the thing that they're very directly affected by our policies almost right away. And the poster child for that is housing. And so you've seen mortgage rates now go back up over 6%. You've seen housing starts come down. Activity in housing has declined as people are reluctant to get out of their the low rate mortgages they had before. So housing activity is slowing down. On the other hand, housing prices went up in the aggregate more than 40% since the beginning of the pandemic. So we may be seeing some price correction on that too. So that's coming along, and housing inflation, which is a big part of the CPI, a little bit smaller part of the PCE, the inflation measures we follow, or we rely on, that will be coming down because of the slowdown in the housing market. I guess I would say the service sector is probably less interest sensitive than that, and that's restaurants, it's travel services, travel and leisure, it's healthcare, it's financial services, healthcare services, all those services, and that's a big part of our economy. This sector is 54%, I guess, 56% of consumer spending on non-energy and food. So it's very important, and it's about having a little bit softer demand and about having some softening in labor market conditions. We think our tools will work on that, but we do expect that will take time.
Thank you. I know the chairman in his opening comments mentioned a belief, I don't want to misquote him, but a belief that we have too little capital in the banking sector. Maybe true of a couple of banking institutions, but how do you feel about the current capital that our broader banking sector, irrespective of where they are in size? What concerns, if any, do you have about the capital that we see out there already?
So I supported all of the capital raising that we did. I joined the Fed in 2012, and we were in the middle of implementing all those Dodd-Frank increases, and I supported all of them. After careful thought and discussion with my colleagues, I think the new vice chair is doing what new vice chairs do, which is to take a fresh look and ask the question, even though I think we all agree capital is strong, certainly the vice chair does. The question is it at the right level? And I think that's what happens with a new vice chair for supervision. We don't have any proposals yet, but at some point we will.
Yeah, I'm going to be meeting with the vice chair, and we'll drill down on that topic. But I do know I was over in finance committee, so I wasn't here, but I do know that several members, well, first off, we know that Vice Chair Barr is looking at a holistic review of capital requirements. I think that that's a good idea. But I have to ask a question. Do you think, does the Fed consider the bipartisan passed Senate Bill 2155, which is currently the law of the land, superior to any of the Basel requirements or any holistic review process? In other words, it is the law of the land. How does that weigh into how these reviews go?
So 2155 was, I think you're talking about tailoring. So Dodd-Frank actually called for tailoring, and what 2155 did is it said changed may tailor to shall tailor, and it also changed the thresholds. But tailoring is an absolutely bedrock aspect of our bank regulatory system, and anything that we do is going to reflect what we think is appropriate tailoring between the different sizes and risks and of the financial institutions that we supervise and regulate.
What we were trying to accomplish as a part of that, I don't expect you to respond, I know that we're coming to the end of the hearing, is that a holistic review of a financial services institution is going to reveal the fact that many of these financial institutions are very different based on the activities that they're most involved in. And those sort of holistic reviews may actually result in increasing capital requirements for two banks that look like peers, but not for another because of the inherent risk associated with their business focus. Does that make sense?
To your earlier point, though, the law, the Dodd-Frank language, and as amended, actually requires that we take those things into consideration. So we certainly will. We will.
Thank you.
Thanks, until Senator Warnock is recognized from Georgia.
Thank you so very much, Mr. Chairman. Before I begin my questions, I know that this committee will soon consider a new nominee to serve on the Federal Reserve Board of Governors. And while it has not historically been the case, it seems to me that the board should reflect the diversity of our nation, that those things are connected. Policy and representation are connected. And I hope that we will see sitting before this committee a nominee that pushes us closer towards our ideals of e pluribus unum, out of many. One, and I support Senator Menendez and others who have called for a diverse nominee, specifically the fact that we've never had a Latino person serve on the Federal Reserve Board. I think it's a huge oversight, and I hope we can move quickly in that direction. That said, my state of Georgia is in a housing crisis. Like much of the country, the Federal Reserve Bank of Atlanta has designated owning a home in Atlanta as unaffordable to the average home buyer. But this is not just a city problem. Harris County, Georgia, with a population of less than 35,000 sitting on the border of Alabama, is also rated as unaffordable. In the midst of this housing crisis, the Federal Reserve continues to raise interest rates. This makes mortgages a lot more expensive for families, especially young families looking to buy a house. According to the National Association of Realtors, the share of first-time home buyers is at an all-time low, while the average age of a purchaser is at an all-time high. Chair Powell, you have said that there has been, quote, an imbalance in the housing market. But if you're a Georgia family, parents in the mid-30s, young children, and all you want is to be able to afford your first home and place and build equity to one day pass that equity on to your kids, how are the Fed's actions helping that family afford a home?
Our mandate is to provide maximum employment, use our tools to foster maximum employment and price stability. And we're using those tools really now to restore price stability at a time of the highest inflation in 40 years. I think that the same people who are having high mortgage costs, if they have a floating rate mortgage, are also experiencing high costs for all the basic necessities of life. And one of our most fundamental roles at the central bank is to keep price stability. So we have to prioritize that in what we do.
Yeah, I understand the tools and the mandate, but my concern is that we could have a cure that's worse than the disease. It doesn't do families any good if we stabilize housing prices while mortgage rates continue to skyrocket. It doesn't matter to me why a house is unaffordable. Maybe the house is unaffordable. Maybe the mortgage is unaffordable. Unaffordable is unaffordable. How does the Federal Reserve consider the total price of home ownership, including costs of mortgages, in executing that mandate to keep prices stable?
Housing inflation is a very important component of various inflation indexes, and the way that's calculated is the economists look at rents, and then for people who own a home, they impute a rent depending on the value of the home. So it actually does factor in, and I would say measures of new leases that are being signed and new housing prices show significant declines in inflation, not in price, but in inflation. And that will play through so that overall inflation over the course of the next 6 months or a year will decline.
If we're seeing mortgage rates go up, yes or no, does this discourage folks who may have a low interest mortgage rate from putting their home on the market and then possibly paying double the cost on a mortgage for their new house?
It certainly could. People who are in a low mortgage, a fixed rate, low rate mortgage, I would assume many of them are not moving.
Does raising the federal interest rate change the cost of borrowing for a company hoping to develop new housing?
Yes.
Does it make it more expensive for suppliers to finance expanding production and meet supply needs?
It does.
Does it give businesses less wiggle room to offer higher wages and attract qualified workers?
Indeed.
Yeah. So all of these actions have to be taken into account. Federal Reserve does not control housing supply, but its actions do have a massive effect on housing supply. And some of these supply effects, it seems to me, will be felt for many years, well beyond when interest rate hikes have slowed or rates have even gone down. And I know you've got a difficult job and a tough situation, but I just hope that the Fed will think more about its actions and how they affect housing supply, even as it attempts to control housing demand. Thank you.
Thanks, Senator Warnock. The last question, I believe, questioner is Senator Sinema is remote from Arizona.
Thank you, Mr. Chairman. And Chairman Powell, thank you for being here today. In raising interest rates last month by 25 basis points, the FOMC cited Russia's war against Ukraine as a key contributor to elevated global uncertainty. The war has serious implications for global energy and agricultural markets. And as you know, energy inflation in particular can appear in the form of higher prices of other goods and services. This feels like a substantial driver of inflation overall. And in my mind, you can't understand the global economy fully without assessing the range of possible outcomes in Ukraine. As we've also seen, the war created new supply chain problems overnight and has caused abrupt price swings in select committees. How is the FOMC assessing the economic impact of the war and the range of potential outcomes in order to inform how it sets monetary policy?
So the principal, I guess there are two things to say. One is that the principal way that the war has affected our economy is really through commodity prices, grain and particularly energy prices. That's the main thing. I think really, and those have both flattened out. Energy prices globally have settled down and they're at a higher level, and and food prices as well to some extent. So the second thing I would say is that it represents a significant risk. So the war in Ukraine, the outcome is uncertain, developments there are uncertain, and you have to think of it as a source of potential risk to the global economy and to our economy. We don't, and we look at alternative scenarios and things like that. We don't really do it from a geopolitical standpoint, but we do, of course, model scenarios where commodity prices are higher and things that would look like what could happen from Ukraine.
Thank you. At home, Arizona families are struggling to navigate this economy. Higher prices are making it more difficult to afford groceries, gas, rent, and airfare. But on the other hand, rising interest rates are crowding out investment and making it more difficult for first-time homebuyers to buy a home. Inflation has also slowed housing development to a halt in Arizona. And as you know, Chairman, housing is a major economic contributor in my state. It's also clear that more spending comes with trade-offs. And it's why tackling inflation has historically been so difficult. And yet it's more important than ever that we get it under control. There's been much debate about a soft landing, where we get inflation under control without triggering a recession, versus a hard landing, where inflation comes down but triggers a painful recession. Some economists are currently saying they see no landing right now, that growth is actually accelerating, and that more aggressive actions will be needed to get inflation under control. If true, that would be problematic. What do you think about that assessment?
Well, as I mentioned earlier, I think if you look at the data that's been coming in since earlier this year, you have seen stronger labor market conditions, higher inflation, stronger consumer spending, and also we saw some of the low inflation readings from the fourth quarter of last year revised away. If you take all of those, they kind of all, they may be to some extent related to things like seasonal adjustments or a warm January, but nonetheless, they all point in the same direction. And they do suggest that the possibility that that ultimately would need to raise rates higher than had been expected. Of course, we have 2 or 3 more very important data releases to analyze before the time of the FOMC meeting. Those are going to be very important in the assessment we have of this relatively recent data. We'll be looking carefully at that, and all of that will go into making the decision, which we have not made, but making the decision that we'll make about what to do at the March meeting.
Thank you. On February 23rd, the Fed, the FDIC, and the OCC released another joint statement on crypto assets and liquidity risks posed to banking organizations. It's clear that regulators see undue risk for banks in the current environment and are taking a more conservative approach. Do you believe these risks are inherent to crypto assets and how they behave, or are some of the risks a product of the current regulatory and policy landscape for crypto assets in the U.S.?
I need to fix that echo.
So we're seeing really in the last close to a year now, we've seen just a remarkable set of events in the crypto space. Lots of companies collapsing. We've seen massive fraud. We've seen all kinds of things. I think, you know, we have to be open to the idea that somewhere in there is technology that can be featured in productive innovation that makes people's lives better. However, in the near term, we see in crypto activity lots of things that suggest that regulated financial institutions should be quite cautious. And that's in doing things in the crypto space. And that's what we've issued 3 or 4 releases to the banks, along with the OCC and the FDIC, the Fed has. And they essentially say, you really need to be careful here. You need to be careful. It's early days with crypto. There isn't the appropriate regulation. We're learning lots about the risks, and they are many of the same risks that run in other parts of the financial system, but without appropriate regulation.
Thank you, Senator Powell.
Thank you.
Thank you, Senator Sinema. We conclude the hearing. The Fed must make sure that workers and families are at the center of every decision it makes to strengthen our economy. We've heard a lot today about the role that Wall Street plays in our economy too. As you've said, Mr. Chair, we know that higher capital requirements make banks safer and stronger. It allows them to make investments in their workers and their communities and our economy. That's what they should be doing instead of spending billions on buybacks. I look forward, Chair Powell, to working with you to strengthen our economy. For senators who wish to submit questions for the hearing record, these questions are due 1 week from today, Tuesday, March 14th. To Chair Powell, please submit your responses to questions for the record 45 days from the day you receive them. I thank my colleagues for the very, very good attendance today. Only one member on each side was not here, one for health reasons, the other just because he's doing 12 different.
All right, guys. So yeah, we're going to go ahead and close it down there. Let me know what you guys thought. One thing here, guys. Look, I see a lot of emotion in chat. I took a short position when the market was like right here. Like I took a short position like right around there, and people were like, ah ha ha, this guy's shorting. And then we dump, and then it's just kind of crickets. You know, when the market pushes up a couple candles, everybody's like, ah ha ha, shorts. When the market pushes down a couple candles, everybody's like, ah ha ha, bulls. It's like, y'all need to take a step out of it. One comment I definitely, y'all need to stop being so emotional about price action here. The movement was down. If you guys heard me before the stream, I told you guys I thought we'd probably drop from this because we've had worse economic data come out in between the last time he spoke. And that was right here. We did pull back some, obviously. And so, yeah, in the end, nobody knows what's going to happen. I did agree with a comment. Somebody said, yeah, I do agree with Andrew's comment here. You guys shouldn't be thinking up or down. Just be a surfer, ride the waves, ride the extension, stop being so emotional about it all. And yeah, hit that subscribe button, guys. We got Jerome Powell speaking in front of the House tomorrow. So he's going to be speaking in front of the House tomorrow. So be sure to check that out. Also, if you want to day trade these big economic releases, the futures market, this is essentially me day trading the S&P 500 is what you see me doing here. I'm essentially day trading the S&P 500, and there's no PDT rule. You can day trade in short futures without restriction with futures. I'm essentially day trading the S&P 500. And if you want to try this out, one of my sponsors is called Top Step. Top Step, what they do is they give you a demo. And if you can hit the target on their demo while following their rules, if you can hit the price targets on that demo while following their rules and conditions, then they legitimately fund you. And this is a company that's regulated by the Chicago Mercantile Exchange and pays out millions in actual withdrawals every year. So if you pass their profitability test, they fund you between $50,000 to $150,000 with a 90% profit split. And again, it's the easiest way to test yourself. Most people are going to lose these challenges, but if you're getting started day trading and you want to day trade, it's so much cheaper to lose a funded account program like this. The base one's $140 a month. It's so much cheaper to lose something like that than it is to put up $30K and risk thousands and thousands of dollars. It gives you a beautiful, perfect middle ground of pressure to where you have some pressure. So you learn how to trade under pressure, which is what trading is about, but you're not risking thousands to do it. And so it's a great way. And then if you're good enough as a trader, you can actually get funded. Check them out. They are a sponsor of my video, so I'm certainly biased in their favor. Here's the link if you want to check them out. Great way to help support the channel. You can also find the link in the description. And yeah, you can see the link right there. Another thing to check out, guys, is check out Chart Prime. Chart Prime is incredibly useful as well. If you look at Chart Prime is a trading view indicator service. You can see I'm actually green on the day. And one of the reasons I'm green on the day is from Chart Prime. Like, look at Chart Prime's alerts here. And you'll see kind of why I wanted to take some of the trades. This is a trading view indicator service. So they give you custom alerts, custom signals, and look at how accurate they have been since the opening bell. So they give you reversal signals. They show you where the support and resistance lines are. You can kind of see they give you range, support and resistance. But look how accurate they've been since the opening bell. Again, right at the bottom here, at the bottom candle, they said they had 2 or 3 candlestick patterns, as well as a reversal up signal. And then you get a huge rip up over like an hour period of time. And then right at the top of this one, they give you a reversal down signal. And these don't repaint, like these don't correct to make them look more accurate than they are. These are actually when they showed it. And then you get a huge drop over hours here. And then the last one, again, right at the top, possible reversal down, and you get a nice little drop. They also show you range support. They label support and resistance. They show you chart patterns. And when you think about the edge that this gives you, again, this is a sponsor of mine as well, so I can't guarantee you're going to make money with this either. They pay me money, so I'm biased in their favor. But when you think about the edge they give you, again, it's like $35 a month for this. You can use it in stocks, crypto, Forex, futures. You can use it on long-term time frames. I can put up an hourly chart here and look at it from long-term time frames and see if it gives me reversal signals, support or resistance. Look, this is over an hour period of time. Look at this. This is over an hour period of time. It gave you the reversal up signal on a hourly chart. So every candle is an hour. And look at the huge bounce back we've gotten over literal days. And then the last one was a bearish engulfing candle up here. Over literal days, we got some price action. And so again, when you find them mixed together, it can be very powerful. I can't guarantee you're going to make money. They are a sponsor of mine, but like I said, it's $35 a month. So check them out. I love you all. We will be back. Jerome Powell is going to be testifying in front of the House tomorrow. Same thing, same time. But instead of Congress in a congressional testimony, it's going to be in front of the House tomorrow. We also have tomorrow non-farm employment change numbers, which will influence markets and some other stuff to go over tomorrow. So again, be ready. We will stream the entire thing live right here. We will stream the entire thing. If you want to check out both of these, again, you can get 40% off of Chart Prime right here at this link right there. You can also find a link in the description. So check it out. Good luck. This one is called the Market Oracle. So this one shows you the support and resistance levels. It shows you the reversal signals. It shows you the candlestick patterns like this and a lot more. This is just a small piece of what they offer as well. But yeah, check them out. Y'all be safe. Love you all. Again, we did have a green day, and I'll see you guys tomorrow. Good luck.